Clamp down there needs to be on Apple. We've also got the two-year yield, and Tom, you were just mentioning what we saw yesterday, that run-up in yields as a result of the services ISM coming in hotter than expected, despite PMI data that came in pretty weak. 107.16, pretty unmoved on euro-dollar as a result of the weakness in the data out of Germany. I did see some movement in bond markets, though, and the wider European bond market space, perhaps as a result of that day two of weakness in data coming out of Germany. And I put in iron ore, down by just nearly 2%, Tom. I put that in because, of course, that sometimes has an impact on the London market, basic resources, all to do with China, it seems.
Yeah, we look at the iron ore price on the softening there. Futures in Germany pointing lower by 0.4%. European equities cannot catch a break, it seems. Here in the UK, FTSE 100 futures pointing lower by 38 points, Anna.
Okay, so days of weakness across European equity markets then, and does that continue? Certainly futures suggesting that we will see some weakness, and we do. The Spanish IBEX down by 0.25%, the FTSE 100 down by 0.2%. The euro I mentioned already, 107 still the handle there, despite 2 days of weak data coming through out of Germany. The dollar index once again catching a bid. That's been the theme of recent weeks. Since the middle of July or so, we've seen that strength in the dollar. Has it run its course? John Author's out with an interesting piece, which, Tom, you picked up on earlier on in the programme. The pound down by 0.2%. Yesterday we saw decent moves, big moves in the pound downwards, as the interpretation of Andrew Bailey's comments yesterday was of a dovish nature, and so that lent some weakness to the UK pound, to the British pound. We've got the UK market here in the sovereign bond column. I see yields coming down a little bit here, so 4.7 the yield on the UK 30-year. It seems to be in keeping with the rest of Europe, though, which wasn't necessarily the case in yesterday's session, and in fact the US 2-year was just there for a moment, just disappeared. But in contrasting moves between the 2-year and the 30-year, it seems, this morning. And some of that weakness in commodities being expressed this morning in Brent crude and WTI, but nothing excessive. Still then, Tom, over $90 on Brent.
Yeah, so the sector breakdown, and on energy, you're seeing a drop in terms of the sector of 0.3%. But as you rightly flagged, more interesting when it comes to basic resources, given the slight softness that come through in terms of iron ore. And of course, as Anna was saying, you can tie that to the China story. So that sector down 0.8%. But equally interesting, if not more important, is what's happening in technology. A drop now of almost 1% on that sector. That's a combination of two factors. It's the Apple iPhone story, so the news reported out of China, out of Bloomberg, that you could see state-owned enterprises, government companies, as well as agencies in China put at least some restrictions on iPhone use. We know that hit Apple yesterday, some of the limited story around that. That story has reported and been expanded, so you could see further downside for Apple. That's weighing on some of the suppliers around Apple. Technology is a sector down 1%. There's the yield impact as well. The run-up in US yields is also, of course, a headwind for the technology sector. Basic resources, as I mentioned, currently down 0.8%. We're looking as well at the luxury space, given the sell-off that we saw yesterday. That weighed on the CAC 40. We'll see if that continues to play out as well. Autos down 0.2%, travel and leisure off 0.5, but really the interest is in technology and basic resources, Anna.
Okay, so we are seeing some impact then from that technology story around Apple perhaps, and also the commodities story, which has played strongly through Asia. Weakness in commodities there. Let's continue the markets conversation. The Bloomberg dollar index hit a 6-month high, while Treasury yields have risen across the curve on increased expectations for more Fed rate hikes this year. That was certainly the conversation on Wall Street yesterday afternoon. That's after that strong US ISM services data. Let's bring in Bloomberg Markets Live. Noor Al-Ali, who's with us on set here in London. Noor, very nice to have you with us. So we've gone from, at the beginning of the week, talking about, well, the Fed's likely to pause, and so that's why we're seeing risk appetite, to, well, the Fed maybe is likely to hike, and the data yesterday seemed to be one of the driving forces there. The dollar continuing to strengthen through that conversation. What do we make of this recent dollar strength?
Absolutely, Anna. And if you look at the data, it's pointing to that still robustness in the U.S. economy. And of course, you still have those price pressures. That ISM report showed you that we still have those price pressures in the services industry. It was also modest in manufacturing, Tom, as well. But the problem remains that the Fed is worried about cutting rates or moving across too soon. And so I think the story here is how much do we keep rates higher, and for how long will they continue to stay high until we rein in on those inflationary pressures?
And it seems to be a more divergent picture for these central banks. Really interesting to hear from Andrew Bailey and members of the team, the MPC, of course, testifying yesterday in front of Parliament and suggesting that maybe the peak is in sight for the UK, for the Bank of England, as people reassess whether maybe or not there's another hike coming through from the Fed. How are you thinking about the divergence across central banks and whether or not a consensus is forming now?
That's an excellent question, Tom, and you can see that through the dollar strength, right? And if we're now in an environment where we're thinking the Fed is going to continue on tightening, or at least keeping those rates much higher, whereas peak rates have stayed, have really we've met the peak rates for both the UK and the ECB, then the question is just how high can the dollar go? And right now, September, seasonally a very good month for the dollar, not so good for risk assets. You're getting that answer in markets, aren't
Right,
you?
so many interesting driving forces when it comes to the dollar. Is it going to be about interest rate differentials? Is it about what the PBOC are doing? Is it about what the BOJ ends up doing? Is it about the European growth story? So many different dynamics to focus on. Let me go to the Bank of England conversation then in a little bit more detail. We saw that weakness in the pound just yesterday. Are we done then? I mean, we've been wrong-footed by some of the comments from certain members of the MPC previously.
Yes, absolutely. And you'll see that it's been leaning a bit more dovish, right? We're getting more dovish commentary relative to the Fed and even ECB members who are relatively more hawkish. And I think the concern here for me, at least in terms of the UK here, is are we going to stop raising rates too soon? I think potentially we're going to, the expectation had been that the UK would continue on raising rates and keeping that, the base rate much higher relative to the ECB.
I still don't understand what's changed the calculus for the BOE. The services data is better than some of our counterparts in Europe. The ONS data has been upgraded. Okay, that's backward looking.
Yeah.
But the UK relative resilient story remains. I don't understand what's shifted for the Bank of England.
Yeah, well,
the unreliable boyfriend, as Mark Carney was once described.
But that was a previous boyfriend. Yes. We're on to a different boyfriend. And so still, we get some elements of unreliability.
Can I point you to something that potentially could explain why? It's the housing data. The housing market in the UK is struggling. And we had a report come out of Bloomberg Economics just earlier this week that points that continued weakness in the housing market, reaching levels we haven't seen in quite some time. And that's putting pressure here on the consumer at a level that the Bank of England has to step in here to avert a housing crisis.
And a lot of interesting conversation around the lags in the economy with housing in mind. Yesterday with Andrew Bailey talking about the lags between policy action and impact on the economy, and the fact that those lags seem to be lengthening in their view. That then leans towards maybe a pause before you see some of the signs of the tightening in the economy. But again, it goes to that whole data dependence narrative, which we get from so many central banks. If you wait for certain bits of data, then you might be too late.
Yeah, absolutely. And look, we have a maker survey coming out of the BOE today, and it's going to shed some light into what the economy is doing, what the expectations are when it comes to inflation, and that's going to inform us of whether or not we're going to see the Bank of England potentially step up. We've seen the Polish central bank surprisingly cut rates yesterday by higher than expected. Is this the beginning of the tide turning for central banks globally, and does it start with Poland?
Really interesting. Or is it all about politics and an election in Poland? But you're fascinating to point out the real estate sector, or at least the housing sector in the UK, on a day when Halifax is flagging again that UK property prices have fallen the most in 14 years. Gilts, by the way, being bid again, yields coming in, and the pound is under pressure, down about 0.2%. Bloomberg M-Live's Noor Al-Ali, thank you very much indeed. Now, New York Fed President John Williams will be sitting down with Michael McKee at the Bloomberg Markets Forum today. That exclusive conversation will be live across all Bloomberg platforms at 8:30 p.m. UK time. Let's check in now on some of the individual stocks on the move with Joe Easton. Joe.
So Smurfit Kappa shares actually ticking lower now in the early start of trading in Dublin and London, where it has a dual listing. Now, this is actually Smurfit Kappa buying the US firm WestRock. We saw WestRock shares in the aftermarket in New York rising around 12%. but it is potentially a big payout for Smurfit. And we're seeing a decline in DS Smith, the big rival, potentially some concern around competition in the paper and packaging market. It's a bit of a mixed picture, though, with some of the other smaller firms like Stora in Helsinki and Mondi in Johannesburg rising. So there doesn't seem to be a consensus yet on whether this is about competition or whether it's about more M&A in that sector. So we'll watch those closely. But Smurfit now down around 0.6%. And in terms of the other stocks we were watching before the open, there were a few decliners and gainers as well. So LSC, that share placing at a discount, it was sold at a discount of around 4%, and the stock now ticking down around 2.5%. Blackstone offloading another £2 billion worth of LSE shares this morning. Direct Line, the big gainer here in the UK, they've actually sold one of their businesses to RSA, which was taken over. That's worth around £500 million and boosting that stock this morning. Melrose as well, another one here in the UK, doing pretty well. They've got a new CEO. This is the aerospace supplier that recently spun off their Dalways business. They do a lot of engineering for many UK companies, reporting strong results today and a new chief executive. Then Currys is holding up at the moment, most of the weakness in the UK, but as RBC analysts note this morning, the company does maintain its full-year profit guidance, so that one actually pretty much little changed at the moment. Then there was just a couple of rating changes this morning on our radar, so we get a new buy rating from HSBC on Money Supermarket, that one gaining 2%. This is a website that's doing even better during the cost of living crisis as people look for better deals on their gas and electricity, according to that note from HSBC that I read this morning. And finally, Cone, the industrial supplier over in Helsinki. Now, this one has big exposure to China, so it's a play on the Chinese growth story, and Barclays goes underweight on that one, saying the China worries will weigh on the shares going forward, and that one is dropping around 2%.
Joe, thank you very much. Joe Eaton from our equities team with the latest on some of those movers and stocks where we've seen some news flow this morning. Let's get to some of the events we're following for you today in markets. Bank of England's, we just heard about this from Noor, in fact, the Bank of England's August decision maker panel will get the details of that survey. They will give the Monetary Policy Committee an update on price and wage inflation expectations. Look out for that at 9:30 a.m. London time. Half an hour after that, at 10 a.m. UK time, we will get the final reading of second quarter Euro area GDP. Just what does weakness in the Euro area look like right now? 1:30 p.m. UK time, we get an update on US initial jobless claims and unit labour costs. What's the story of cracks emerging in labour to tell from that data? And later, Bloomberg's exclusive with the New York Fed President John Williams at the Bloomberg Market Forum. That's at 8:30 UK time, 12:30 p.m. Eastern time. Then just about 15 minutes after that, Atlanta Fed President Raphael Bostic will be speaking on the economic outlook on a moderated panel.
Coming up, Poland's central bank delivered a surprisingly steep interest rate cut in a bid to boost a slowing economy, as Nora Hourly flagged for us. We're going to talk about emerging markets next. Is this idiosyncratic to Poland or speaks to a wider trend? This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because this is really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see you've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Bloomberg's Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out today at 3:30 p.m. Eastern, only on Bloomberg.
Welcome back. This is Markets Today. We are 14 minutes into the European trading day. Losses of around 0.4% across the European benchmark, setting ourselves up for potentially 6 straight days of losses. One sector in the green, but only by a thread: construction and materials. Bottom of the list, basic resources down a full percentage point on the back of softer iron ore. Technology also taking a hit, down 0.8% on concerns about Apple's exposure to China. Let's get to the EM space now. And Poland, this was really remarkable what came through yesterday from the Central Bank of Poland, delivering a surprisingly steep interest rate cut in a bid to boost a slowing economy. The benchmark rate was lowered by 75 basis points to 6%. It's the biggest reduction since the great financial crisis in 2009. And it comes less than 6 weeks ahead of a tightly contested election. Let's get some analysis then and bring in Phoenix Callan now, Global Head of Emerging Markets Research at SocGen. Phoenix, thanks for joining us this morning. What is your take then on the decision from Poland? Is it idiosyncratic to a country that's facing an election? Is it the politics of the central bank and their proximity to the ruling party? Or does it tell us a little bit more about where central banks in the EM space may be looking?
I think this story is mostly idiosyncratic. It's not all of it. Part of it is driven by the macro environment of them being quite concerned about the slowdown that we're seeing in Europe and how that's going to feed through to further deceleration in Poland. But I think on the whole, we do have that political context in mind around elections coming up. That is, as you mentioned, very tightly contested. Polls are showing they're neck and neck. And they are kind of shifting the arguments in the recent communications from the central bank toward pointing out kind of the headline decline in inflation, concerns about consumption. But we would argue that Poland's economy is very strong. Economic fundamentals are really robust. They've got a strong labor market. Unemployment rate is at the lowest level ever. Wage growth is really strong. And then they're looking at still double-digit inflation. So it was premature to engage in this rate cut, but we had been anticipating that they would do this ahead of elections at this meeting and also at the next.
Yeah, I mean, are there economic reasons to cut rates like this, Phoenix, with inflation still over 10% in Poland?
So, I mean, I think the economic arguments would point toward staying on hold for a longer period of time to see kind of the impact of the economy, how that plays out, wait for inflation to come down based on the previous hikes that they've done in past meetings. So in our view, it was premature. But I think given how they are maybe a bit more focused around juicing up the economy ahead of the elections, showing that they are there for consumers wanting to bring down rates, and that would play very well with the population. So I think it's understandable in that context.
Phoenix, I want to step back from the zloty and all things Poland to look more broadly at your EM space and how you're thinking about dollar strength as you assess how to position within EM. Are you getting the sense that maybe kind of US exceptionalism and that flight to the greenback is starting to run its course?
Well, no, it's still persistent. We are expecting for it to still be one of the dominant themes for the rest of this year. And I think we'll expect more of a dollar weakness return into the first part of next year. But for now, we think that theme is still there. The economic data is still very strong. We're still kind of debating whether or not the US is going to see a soft landing versus a no landing type scenario. And recession calls have been increasingly being pushed out. At our bank as well, we pushed out the recession call for mid-year next year. So I think that the arguments for rates to be higher in the US and for them to stay higher for longer, those are still going to be dominant in impacting how investors look at EM. And I think that that's still going to persist for the rest of this year.
Conversations around China tend to dominate emerging markets at the moment, Phoenix, and the weakness in the Chinese economy and the way that the PBOC is intervening to support the currency and to try to steer the currency. A recent Markets Live survey suggested many in the market continue to see the Chinese currency weakening, and you seem to have a very eye-catching call with that in mind. You say to reach 7.6 to the US dollar by year end. What explains that weakness for you?
So, we have a model for us to forecast this dollar CNY number. And for us, looking at the various fundamental technical factors around, we are expecting for a little bit more of dollar strength. We're expecting for the 10-year yield differential to widen further. Those are some of the important factors. And then things around maybe a moderate increase in the trade surplus, maybe some decline in exporters' FX conversion rate, for instance, but the PBOC will still be there trying to maneuver on the fixing. So we've incorporated these assumptions into the model, and for us, it's reasonable to see dollar CNY maybe drifting upward around 0.2 to 0.3 from current levels.
Okay, interesting call on dollar CNY at 7.6. Your highest conviction call, Phoenix, is outperformance of LATAM currencies versus EMFX. Can you just unpack that for us?
Yeah, so LATAM markets, especially on the currency side, they've outperformed strongly over the course of this year up until maybe early August. And there's been a huge regional divergence. They've really capitalized on the themes around the geopolitics impacting other regions more so than LATAM, the nearshoring that's been happening, the improvements in remittances, and in terms of trades, those have really fundamentally improved LATAM. And then on the political side as well, we've seen much less political noise. We've seen some improvements around things like fiscal dynamics coming out of Brazil, for instance. So we think that that LATAM risk premium is still going to ease in the context of still other troubles being much more prominent in other parts of the world. So there's more arguments for investors to maybe move portfolio flows into the LATAM region. We're not expecting for the US to enter any kind of hard landing, for instance. We're expecting for yields in the US to gradually go lower, especially in the long dated end, and then for cross asset volatility to come down as well. So these are still relatively beneficial confluence of factors that is likely to benefit LATAM, which is quite geared to strong US growth.
Phoenix, thanks so much for joining us. Thanks for speaking to us here on Bloomberg TV. Phoenix Kalen, a global head of emerging markets research at Societe Generale. Coming up on the program, a rare changing of the guard. The billionaire Peugeot family's holding company has a new CEO. We'll bring you more on that developing story next. This is Bloomberg.
Is as safe as it was when you were in the government? It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising
Yeah,
New York
the
City?
mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Welcome back to Bloomberg Markets today, 24 minutes into a sluggish session here in Europe. Let's get to a corporate story, though. The billionaire Peugeot family's holding company is undergoing a rare change of the guard. It has named the lawyer Nicolas Huet as its first new CEO in 18 years. Let's get the latest story here with Bloomberg's Caroline Conan, who joins us now from Paris. Caroline, good morning. How significant, then, is this change?
Anna, of course, Peugeot is the iconic French brand which makes pepper grinders, tools, luggage, and of course cars from the 207 to the 3008, and that is now part of the bigger Stellantis group. So today the news is that Établissement Peugeot Frères, which is the holding company managing the family's fortune, is having its first change of CEO in 18 years, nearly 2 decades. The new CEO, Nicolas Huet, comes from the investment firm Eurazeo. Of course, the Peugeot family is a very prominent, billionaire, wealthy family in the industrial sector, going back to more than 2 centuries, kind of similar to the Dassault family, for example, in defense and aviation. The Peugeots go back to 1810, when actually one of the ancestors transformed the windmill into a tool workshop. Today, the Peugeot family actually controls about 7% of Stellantis since the merger of PSA with Fiat Chrysler back in 2021. They also were brought together with the Agnellis, another wealthy family from Italy, which has today a 14% stake in Stellantis. So all this, of course, exposed the family divisions of the Peugeot family about a decade ago when Peugeot was losing a lot of money and they lost control of the brand. And today they have been diversifying also into the banking sector.
Caroline, I can't believe we've run out of time and I can't ask you about those peppercorn grinders. They're very nice, but I've never understood why Peugeot makes peppercorn grinders. I do have envy when I see them in other people's homes. Caroline Conan, thank you in Paris. Coming up, the UK. This is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
DOJ or other authorities
could face bigger challenges next.
Was going to keep rating World Cup. This is a 3.
As the economic picture down.
The OK is getting ready to make a decision.
This is Bloomberg. This is Markets Today, 30 minutes into your European trading day. Here are your top stories. European stocks and S&P futures extend losses and the dollar firms after an upbeat ISM services print raises prospects of a Fed hike. Meanwhile, Apple is set to face a widening Chinese workplace ban on the iPhone. Nasdaq futures fall. Chinese exports also dropping, but less than forecast, giving some hope the world's second largest economy could see stability. Plus, BOE Governor Andrew Bailey says the UK may be nearing the end of its rate cycle, sending sterling to a 3-month low. Tom, a lot of focus on the UK side yesterday with that move in the pound, a little bit of weakness still in the pound this morning. More broadly, though, the Apple story seems to be having an influence.
Yeah, there are a number of downdrafts for these equity markets, and it just continues the selling pressure. They're looking, it seems, investors for a catalyst for the upside, but so far not finding one. Yes, there's the Apple story, the concerns emanating around possible further restrictions out of China, the high yield story in the US yesterday. Lower yields in the UK not doing much to lift UK equities, currently at 7,389, below that 7,400 level. This is more of a basic resources story when it comes to the UK. The drag coming through from the miners, and Beazley, one of the leading loss makers in the UK in terms of insurance, a miss there in terms of premiums. That's leading concern around the insurance sector. Insurance, basic resources, a drag on the FTSE 100, down 0.4%. In Germany, the DAX is off by 62 points or thereabouts, a drop of 0.4%. And across the benchmark then, down by 2 points, off by 0.5%. Again, we're in the territory of potentially 6 straight days of losses. Let's flip it over and have a look at the sectors then, see if that basic resources story continues to be the narrative in terms of the main drag. Iron ore prices softening. The demand from steel makers in China is ebbing, and that is leading, of course, to a drop in the demand picture and prices. Basic resources there, down 1.5% as a sector. Energy, less bad than many of these other sectors, down 0.4%. The technology sector, of course, remains in focus for us today in terms of the linkages with the Apple story over in China. That sector down 0.7%. But so far, the pain is really concentrated in basic resources. Also worth mentioning, the financial services as a sector is also down a little over 1%, Anna.
Okay, so yes, the London market weighed down a little by that, and also the basic resources sector you referenced. Let's talk about the UK macro story, though, Tom. Bank of England Governor Andrew Bailey says UK interest rates are probably, quote, near the top of the cycle, with inflation set to fall further this year. He also signalled how fuel prices could play into the inflation picture.
Inflation is coming down, and our sort of short-term forecast is performing better. I think it is, I should say, possibly that we will get a tick up in the next release, because fuel prices went down in August last year and went up a bit in August this year.
And Andrew Bailey there making the point that we could see a tick up in inflation as a result of higher energy prices. Let's bring in Bloomberg's UK correspondent Lizzie Burden, who's been deep diving into the comments we got then from the governor. So Lizzie, how does this set us up then for the Bank of England meeting in a couple of weeks?
Well, I mean, the pound's not thanking Andrew Bailey this morning. The last time I checked, it was below $1.25. And you saw it happening yesterday. So Andrew Bailey's comments in his testimony to Parliament had it sinking. And then you had that big drop on the ISM data. So clearly it's also a dollar story. But gilt yields were the outlier in the bond story as well. Look, what he said, as you say, was that rates are probably near the top of the cycle. He does see a marked drop in inflation, but it's the clearest signal yet that the bank itself is worried about this risk of overdoing it and that there could be an unnecessary recession in the UK. The question becomes, if the bank pauses at the next meeting, when will the bank cut? Is it going to be after the ECB and the Fed? And the risk is that if the Bank of England is expected by markets to hike, but actually it goes for the pause, that it upsets the market. And you see gilt yields going higher, the pound going lower, and effectively the market saying this economy is too hot and this policy is ridiculous.
Are we getting ahead of ourselves and thinking about cuts from the Bank of England? I mean, we've got $90 a barrel on Brent. He referenced energy prices in the testimony. We've got some forecasts. We had an analyst focused on energy yesterday on the show, suggesting that $100 a barrel certainly can't rule that out by the end of the year. The resilience in the UK economy, relative resilience that we talked about, Anna, remains for this economy. And we're starting to talk about cuts from the BOE.
But it's the inevitable question, isn't it? Actually, Oxford Economics put out a really interesting note in the past 24 hours where they said they see the BOE cutting after the ECB and the Fed, a few months after in 2024. But you mentioned the resilience of the UK economy. They're not so confident in that. And it echoes the comments of Michael Saunders, former Bank of England policymaker on the Bloomberg UK Politics podcast. Remember, he was the big hawk on the committee, but actually he says, forget about this ONS revision. The growth outlook for the UK economy, the potential growth, has been weak since 2010. And even though he was the hawk, he says it's probably time to stop the hikes.
Yeah, really interesting to hear that from a hawk then. Lizzie, thanks very much. Lizzie Burden, our UK correspondent here at Bloomberg with the latest then on the UK macro story.
Okay, let's check in on the individual stocks on the move with Joe Easton. Joe, what is standing out to you?
So we've got drama in the market for cats and dogs today, which is something I wasn't expecting to be reporting, but the CMA in the UK has just announced that they are going to review the veterinary services market for household pets in the UK. They say this covers dogs, cats, rabbits, and not large animals such as horses and ponies, according to their statement. Now, this is absolutely...
Where are we going with this, Joe? This is brilliant.
This is absolutely slamming two stocks at the moment. Pets at Home, the UK retailer that also provides vet services, down more than 10% in London, and CVS, which is a veterinary services firm, down 32%. Now, this reminds me of a few years ago when the CMA announced a review into the funeral market, and that sent shares of Dignity down around 50% over the next few years. That was eventually taken out. We'll have to see where this goes, but the market is not liking that news that the CMA is investigating pricing for household pet services. So those are the big ones today, but lots of red on the screen. Smurfit Kappa, surprisingly, continuing to go lower. That was after they announced that merger deal with WestRock, still in negotiations in the US. That would be a lot of money for that firm to spend, and that is weighing on that stock this morning. And the other big dropper today, not as fun as cats and dogs, but Synthoma, the chemicals firm, announcing a big rights issue after they recently did a couple of profit warnings, so they need a bit of extra cash, and they're having to go over to some of their investors and ask for money at a discount. And that stock, another big decliner today, down around 26% in London. So some massive moves today in the UK. We're going to flip over and look at a couple of gainers. So Direct Line, that's the best ever gain for that stock now. It's been listed for 11 years and it's up 13% today after they sell around £500 million worth of their business to their old rival RSA. That was announced last night, and they've also reported a 25% jump in some of their premiums for people insuring their cars. That's a really strong market at the moment. And the other ones have got a bit of an aerospace feel to them at the moment. So Melrose, we mentioned earlier, a new CEO and also some strong sales. They make jet engines. Airbus announced a jump in orders after the close of trading yesterday. They had orders for more than 100 planes in August, which is almost double what they saw in July, and that is feeding through to their supplier, MTU Aero. So some aerospace ones to go along with those pets movers earlier in London.
Joe, thank you very much. Joe Easton from our equities team with a very serious story of a CMA review into the pets market. I thought it was one of those truisms in retail, though, Tom, that there's no limit to the amount of money that people will spend on their pets, especially perhaps all those lockdown dogs that everybody seems to get.
Don't we spend more on our pets here in the UK than some small countries' GDP?
I'm sure that's quite possible.
Some of it, the numbers are mad. I mean, he talked about funerals and pets, and I just had this trauma.
Oh, dear.
Like 8-year-old Tom burying a hamster in the back garden. It was dead.
Okay, I'm very glad.
Alive.
Very glad to hear that.
Pet thing
Okay.
is real. This is an industry that's worth delving into a little bit more deeper.
We will watch for details on that CMA review then into that particular sector. Coming up on this programme, though, we'll get back to the serious business of China exports. The slump easing in August, it seems, in the data is the worst over for the world's largest economy. We will discuss that next. We're seeing a bottom to that Chinese data. This is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
India is the world's second largest phone market, over 200 million sold last year. A decade ago, most of them were imported. Now the country is a net exporter, with Samsung and Apple leading the charge. Prime Minister Narendra Modi wants to repeat this phone success across electronic goods, electric vehicles, green energy, chemicals, textiles. The near-term goal is to reverse the declining share of manufacturing in GDP, targeting $1 trillion in goods exports, and most importantly, creating jobs for the largest working-age population in the world. But standing in the way of this manufacturing ambition are some old challenges: land acquisition problems, high logistics costs, and some new ones as well: automation, lack of skilled labor. Take phones, for instance. The government has implemented a mix of high import tariffs on finished phones and production incentives to boost local manufacture. But supply chain indigenization is a long way off. According to one report, Indian factories add 18% in value to the electronic devices they assemble for export, compared with 38% in China and 24% in Vietnam. Manufacturing in Vietnam is also cheaper by at least a tenth. The Make in India campaign will benefit from record investments in infrastructure and logistics. There's also the lure of a potentially large domestic market. And now there's the China Plus One wave, as large global corporations seek to mitigate geopolitical risks and a slowing China economy by diversifying their supply chains. Since the liberalization of its economy in the 90s, India has come to be known as the back office to the world. But to become a developed economy, the government also needs it to become the factory to the world.
Bloomberg's Menka Joshi there on India's manufacturing ambitions ahead of the G20 meeting tomorrow. And of course, Tom, a lot of that India on the rise in terms of manufacturing story ties in very neatly with China's struggles geopolitically to hang on to some of its manufacturing.
Yeah, as was outlined in the package, a beneficiary of some of that reshaping of the supply chains. And talking of trade and China trade, China's export slump did actually ease in August. Overseas shipments, they fell close to 9%, 8.8% in dollar terms year on year, while imports contracted as well, 7.3%. Both readings, though, better than the estimates. Let's go to Jill Deesis in Hong Kong. Jill, break down the data for us. Any signs then that imports may be picking up in coming months? Are we seeing a turnaround?
Hey, Tom. Yes, I think that it maybe is too early to say definitively that we've seen a turnaround, but I do think that this adds to some optimism in terms of the data. Remember, it was just last week that we got some pretty positive manufacturing PMI figures, at least relative to everything. I mean, the official PMI, manufacturing PMI still fell, but it wasn't as bad as we had seen, and that private gauge picked up. That was indicating that maybe actually domestic demand was a bit stronger than we had initially seen, and that's feeding through to this import data that we just saw. We talked to some economists who've said, maybe there's room for that to pick up in the coming months. And again, back to that export data, that falling less than we expected as well kind of indicates that there's a little bit of room for growth there. I was looking through some of the regional breakdown data earlier. You saw the slump for shipments to the U.S. falling by much less than it did in July. So overall, again, I think we still need several other indicators to actually definitively say how much of this is maybe putting a floor under the slowdown right now, but this is at least some early positive signs for now.
And the latest on the PBOC then, Jill, as it tries to resist the downdraft for the Chinese currency, the PBOC setting another strong fix, and actually setting a strong fix for 54 days in a row, which I think is a record.
Yes, it is. And I think that when it comes to how the PBOC is operating here, I mean, look, I don't think that there's we're not really seeing a major strengthening of the yuan. A lot of this really just comes down to managing this depreciation. I think that we're still seeing some issues there. Obviously, remember, it was just last month that we were hitting weak levels since 2007. We're right down there again now. I think that at this point, the PBOC, though, indicating it's offering some of the support here, maybe an effort to shore up some confidence among investors, which remains weak, even if we're getting some of these early signs of positivity within the economy. We'll just have to see how much of that sort of continues with this drumbeat of support that we've been seeing over the past few weeks.
Yeah, it was interesting. We got a call from Felix Callan over at SocGen earlier in the show on 7.6 for the Chinese currently. It's currently trading versus the US dollar currently at 7.32, but 7.6 is the call there from at least one strategist. When it comes to what's happening with the Apple story, Jill, how consequential is this? How much should we read into it? Clearly, Apple selling off yesterday is likely to fall again. The Nasdaq being weighed down by this story. What do we know?
Yes, I actually think this is quite significant, Tom. So what we know so far is, look, the Chinese government already precludes people working in sensitive departments in the government from using iPhones. What we're hearing now is that they're considering expanding that to employees in state-owned enterprises and other sectors that sort of fall under this much, much larger umbrella. We've already seen some indication that maybe officials are telling some of their workers to not take their iPhones into work. I think in particular, if you're seeing any kind of indication there that China may ban iPhones from people working in state-owned enterprise, that's a huge deal for a market that provides a fifth of Apple's revenue. I mean, some of these SOEs, you look at Petrochem, for example, these massive state-owned enterprises that employ millions of people. I think that certainly has some pretty troubling implications for Apple. Again, not yet. I think a lot of that's still under consideration, but we'll see how it develops.
Yeah, absolutely. So security concerns, it seemed, to the fore when it comes to China. Perhaps not so much the economic concerns. I mean, when you think about the role that China plays, for Apple, it's still such a huge manufacturer of Apple, despite the fact we cover a lot, of course, the shift in manufacturing to India and other locations. But China is still such a big producer. And also around a fifth of sales, I think, for Apple still go to China, Jill, just underscoring the significance of this, the world's second largest economy for this giant business.
Yes, certainly. I mean, again, yes, the fifth revenue really coming from China. I think, no matter what ring fencing some of these American companies are doing, or in, Apple's case, certainly trying to diversify. I mean, you mentioned India. That's still obviously there's a lot of development that has to happen there. As you said, Anna, China remains a key market for Apple. So yes, I think any indication that China is trying to distance itself from Apple even more, giving people incentive not to even buy iPhones anymore is troubling news if this goes forward.
Jill, thanks so much. Bloomberg's Jill Decis joining us there with the latest on China. Coming up on the program, the dollar is heading for a third day of gains. We'll take a closer look at what that means for markets. That's next. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Markets Today, 8:52 here in London, 52 minutes then into a European session that looks negative, down by around 0.3% on the Stoxx 600. Basic resources has been the weakest sector this morning for much of the first hour of trade. Iron ore prices a little bit weaker. Let's talk about what's happening in these markets. Eddie van der Veld joins us from the Markets Live team. And Eddie, we've got negativity on European stocks today, negativity on the US yesterday, and the higher yield story driven by better data out of the US seemed to be the trigger.
Yeah, I think so. I think, the story is, of course, that if you've got stronger data now, that probably means that the Fed might have to hike another couple of times. I think the data was a lot more nuanced than people are reading into it. I think particularly once you take the beige book into account, right? If you're not just looking at the ISM data, because the beige book, of course, told us that there's some weakness in the jobs market, and that inflation, crucially, isn't expected to continue. Companies don't feel they have as much pricing power, and I think that therefore this is much more about a soft landing narrative that we got from the US.
Yeah, I was interested. Cameron Christ, his take on the beige book, saying this looked very late cycle, and Mark flagging to us that it was a bit more, there was a bit more information, it was a bit more colourful than just a sort of beige name.
Well, yes, maybe they need to rename it, at least temporarily. I mean, they were talking about, the drawdown in terms of savings in some parts of the US, and maybe this is kind of the last hurrah in terms of that revenge spend. What do you think? What do you think is the next kind of catalyst for these markets? We're looking at a 6th straight day of losses for European equities. Is it about central bank clarity? Is it about the data? Is it something else?
Yeah, but that's the beauty about something like the beige book with anecdotal data, is that you can read almost anything you want to into all of the readings. I think the market moving forward, I think there is obviously the macro stories, and that is going to be at the forefront. But we're also going to look a lot at the micro, and I think things like what we heard about Apple and the ban in China for some of the at some of the government departments and so on. I think that really matters, because I think, it just shows that China is going to step up the balkanization of global tech sectors, and they have much more power to do so than the US does. And I think this becomes more important as we head towards a US election next year, right? I think that you're going to see rhetoric being ramped up, and that therefore probably or potentially putting some pressure on exports from the US, from its consumer tech sector and the hardware sector.
Oh, yes, and we were talking to Peter Elmstrom last hour, weren't we? And he was making the point that if you impose these sanctions on China, on its ability to get Western technology, which has been the case, then you might speed up China's ability to sort of stand on its own 2 feet and to balkanize technology, as you described. What about the dollar story then, Eddie? Because that's been a real feature of markets. We've covered it's once again the feature this morning. We've got the dollar stronger, the pound weaker, for example. We covered this John Author's piece earlier on, asking questions about whether the dollar rally has gone too far and sustains from here.
Yeah, absolutely. Look, I think the dollar and the US broadly is looking, to use the old cliche, the cleanest shirt, right? I think the US economy is still fairly strong. Inflation's somewhat under control, but they probably not seeing that sort of weakness that will force them into cutting rates anytime soon. And I think, therefore, people are feeling a little bit safer in the dollar, but the dollar is the flip side of the everything rally, and it has been for the last year or so. That, if you see the dollar going up, it just puts pressure, and it shows that people are taking their money out of other things.
And Eddie, you're flagging for us an interesting story that it's worth spending a bit of time on and extrapolating beyond this particular state, which is Texas and the pressure on the power grid there, but the global implications.
Yeah, I think this is a long-term story that we need to keep an eye on, right? Because I think, and we saw that last year, we saw previous years that there's been underinvestment in Texas, and that that their power grid comes under pressure. The problem is, though, that this is a global story. We are putting so much more pressure on our power grids, and we really just haven't invested enough money in it. So this is something that could happen elsewhere as you electrify your car fleet and so on.
Yeah,
it just you might not have the power to back it up.
Yes, and here in Europe, as we electrify increasingly home heating, it's the story, isn't it? But smart grids, battery storage, all very much being thought about in that context. Thanks so much, Eddie, for joining us. Eddie van der Veld from the Markets Live team. Remember, you can get up-to-date analysis and insight from Eddie and the rest of the team. MLI Vigo is the function to use on the Bloomberg terminal.
New York Fed President John Williams going to be sitting down with Michael McKee later today. Tune in for that. Stay with us. This is Bloomberg.
tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Apple is said to face a widening Chinese workplace ban on the iPhone, a sign of growing challenges for the company in its biggest foreign market and global production base. S&P Futures extends losses, and the dollar firms after an upbeat service print raises prospects of a Fed hike. Plus, UK Parliament returns after the summer recess. Some children might not be returning to school quite yet as the Prime Minister defends his record on school investment and safety. So let's take a look at the European markets map. A lot going on. We have a stellar show lined up for you. Now, we did have some disappointing data out of Germany, and that's filtering through a lot of these European equities. Now, the DAX currently unchanged. Similar story for the CAC. FTSE a bit of pressure, down 0.1%, as is the FTSE MIB in Italy. Now, a couple of charts that we look at, looking at Fed and some of the expectations that have been going on there. The other thing we look at is, of course, downward pressure on U.S. equity futures, and this is because of the Apple story with China planning to ban a lot of iPhones. So let's get to these two charts that really tell the stories in all its complexity. The first one is the U.S. dollar index. You can see this is what it's been doing year to date, 1,256. We could have used euro yen or dollar yen or actually euro dollar, but this is the one that we've used today, Bloomberg US dollar. The story, it says, is of course one of expectations for the US economy. We were expecting no landing, soft landing, no landing, hard landing, and now it seems that it's steady as she goes. The other picture, when you look at a lot of the data coming in from the US, is that there has been enough to prompt Fed officials to scale back their estimates for rate cuts in 2024, although we also had a strong set of numbers overall. Now, 2024 looks set to be a little bit less dovish than expected, and you can see this is the Fed Fund futures for 545 there. The other stories, of course, Apple. This is what it's doing in pre-market. This is after China is seeking to broaden its iPhone ban to state firms and agencies. Pre-market, Apple down 1.6%. Now, China plans to, as we were just saying, because of the share price, expand a ban on the use of iPhones in sensitive departments to government-backed agencies and state companies. For more on all of this, we're joined by Bloomberg's Jill Dices. Jill, good morning. I mean, this is a huge deal for Apple. What does it actually mean on the cards?
Yeah, Francine, this is a pretty significant blow to Apple if this goes forward. So as you said, this already covers sensitive departments. So the idea would be expanding this type of ban to some state-backed agencies, SOEs in China. What we've heard is already that some agencies are telling their workers not to bring their iPhones to work. Obviously a concrete ban would go a step further. I mean, look, this is a country where Apple derives something like 1/5 of their revenue from China. So despite all of the U.S.-China tensions that have unfolded over the last several years, this is a key market for Apple. Obviously, this is not just a key consumer market, but also a key manufacturing market, even though you've seen Apple diversify some of its supply chains away from China, building factories in India, that kind of thing. This still remains very, very critical. And I mean, the extent to which a consumer ban like this would actually work. I mean, state-owned enterprises, for example, you look at the really, really major ones like PetroChina, for example. I mean, these are agencies that employ millions of people within China. So, I mean, any indication, again, that there's restrictions on the use of iPhones in China is, I think, very severe.
So, Jill, South Korean chipmaker SK Hynix also says it's now investigating how its semiconductor components have been used in Huawei's latest mobile phone. What can you tell us about that? It's a crazy story.
It really is, yeah. I mean, look, I think that, there's obviously a lot of attention paid to Huawei right now. Bloomberg had a chance to tear down this Mate 60 phone that Huawei is using. Huawei is putting out. This is, again, Chinese tech, one-time giant that was really a driver of 5G tech, really, really making a lot of cutting-edge technology. And, U.S. sanctions employed in 2019 certainly seem to cripple a lot of its capabilities. Now what we're seeing, though, is that it's capable of building a phone with really, really high-end technology contained within it, with 5G capabilities that are akin to, the latest Apple iPhone. And at this point, I think that, you're looking at, I think, how exactly they're able to do these kinds of things, how exactly they're able to circumvent U.S. sanctions, if that's indeed what they did. It's certainly, I think, an interesting story to continue watching to see how it develops.
Yeah, it's pretty incredible. Jill, as always, thank you so much for all of the insight. Jill Dice is there for us in Hong Kong. Now let's also bring in Plurimi Wealth Chief Investment Officer Patrick Armstrong. Patrick, there's so much I need to ask you, but let's start with Apple. I mean, does this give us an indication of what China's trying to do, or does it put in question valuation for Apple and other technology stocks?
I think it does both of those things. This is an opening salvo potentially from China. Right now, what they've done is immaterial to Apple, but they're trying to build up some political capital to fight back against what the U.S. has done with chips, what the U.S. has done with Huawei. And if you make things more onerous on U.S. companies coming into China, then you have something you can trade with as well. So I suspect that's the thoughts from China. Apple's not a cheap company. I think it's multiple is warranted, given its cash flow generation, and it's not cheap, but it's below 30 times earnings again. So I think that's a level that I'm comfortable to own it at anyway.
So, Patrick, what does it mean? I mean, do you think they'll do more on some of the technology stocks, or if you're an American company with significant business in China, you're in a wait and see mode right now?
Yeah. So if I'm China, that's what I do. I try to build up as much so I can have a counterbalance against what the U.S. is doing to you, and then when you do get into negotiations, you can say, I'll give up this, I'll ease this, and then the U.S. can do a tit for tat and on the good side of things. So I suspect that's China's thought process. I suspect there's more to come. Markets reacting to it, not based on what's happened, but that this may be the opening of what's to come.
Patrick, the other story today, and it's interesting to put, so you have China on one side, and then you have what the Fed does, and we have a couple of speakers before that all-important decision, September 20th. What's the driver of these markets? I know you look specifically at companies, but is it still inflation and the Fed, or because we're nearing the end of the hikes, it doesn't really make that much of a difference?
The Fed's still important because if the Fed makes mistakes and hikes too much, that provokes the recession, and then you don't want to be long equities. So the Fed's not given us a clear signal that they're done with hikes. They're still on the fence with that. I think they're done. They've indicated to us that they're already in restrictive territory. You've got unemployment starting to tick up, still very low levels. You've got inflation on a downward trajectory. If I'm in the Fed, I'm comfortably sitting on my hands here and just letting that work its way through. But more hikes, I think, would be a policy mistake. That's a risk for equities. China growth is nowhere near what anyone hoped it would be at the beginning of the year, but it's still positive. It's probably going to continue to weaken next year. But growth adds demand. I think playing China through energy is the best way to do it, because Every day there's more oil being consumed in Asia and more oil being consumed globally, and there's not much new production coming on.
So you don't see interest rates at 6.5%?
My view is they're done. I think they don't need to. I think it is restrictive territory already. You can see that from inflation and the tick up in unemployment, job openings coming down. The labor market was too tight. It's getting to a level where it's a bit tight, but I think the path is still getting into a pretty neutral labor market. So the Feds, there is a lot of two-sided data where something beats and something misses, but I think that's indicative of a policy that's probably marginally restrictive, and I think they can just let that play out.
Is there anything, so you mentioned energy stocks, I know we'll talk about luxury. Is there anything at the moment that you're selling off?
The last thing we've sold was, we've been reducing some technology stocks. We're 3% underweight, so it's not a massive underweight. So we've reduced equities overall. Our balanced portfolios are at 46% equities versus a 50 neutral, so it's at the fringes. And it's not so much that I'm worried about equities. I'm attracted to the real yields on bonds. Getting a 2% real yield on a treasury and an inflation-protected treasury, 2% above inflation that maybe does grind higher. It's because there is a compelling alternative to equities, not that equities are in a terrible valuation.
But I guess, how do you price, this tit-for-tat, U.S.-China kind of concerns that could be on trade, but that could quickly escalate into something else?
The worst-case scenarios is what everyone starts to price when these things happen, and then they're self-rectifying because no one wants the worst-case scenario. It's building up the capital to provoke the discussion and a path towards better growth. So I don't ignore it. I think it's probably something that is going to be ongoing, but you shouldn't be pricing for the worst-case scenario because both sides don't want that to happen.
You don't own, do you own any of the banks in Europe?
In Europe, I own BBVA, so don't have big positions in banks, but I do own BBVA. I've got lots of bank debt is where I'm playing banks for primarily.
So we're back to school. I feel like the next 12 months, I feel like all the traders also, they're getting their head around, some of the headwinds and what they need to navigate.
Yeah.
What's the hardest thing to do right now? Is it, be prepared for volatility when it comes? Or could we see a big unknown in terms of energy shock?
What we've got is a Goldilocks scenario in the United States. My base case is that you've got the soft landing somehow engineered in the United States, but you've got the opposite of Goldilocks in Europe, which is persistent inflation and weakening growth, and there's not much growth to begin with. So playing the discrepancies between Europe and the US, and China's another story, it is going to be very divergent macro scenes. It's not complete unison the way it was years ago, where everything was going on the same path. So I think that's going to create a lot of opportunities and risks.
What about the UK?
UK, I think, is like Europe. I think I like the growth outlook in the UK better than Europe right now for the first time in a long time. I think
why is that?
It's just Europe's got more issues right now with, if you look at the PMIs, the services, employment, it's more linked to Russia as well. If there's any pickup on oil and energy from Russia, if Europe puts more sanctions on them, which I expect probably has to happen, I think that's going to be a bigger knock-on on Europe. So it's not that I'm bullish on UK growth, but I think it's probably gotten to the point now where it's looking as good as Europe at least.
Okay, thank you so much, Patrick. Plurimi Wealth Chief Investment Officer there, Patrick Armstrong, stays with us. Coming up, we discuss luxury goods stocks after more than $25 billion was wiped off from the sector's market value in just one day. That's next, and this is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see Got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Today, Bloomberg's Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out today at 3:30 p.m. Eastern, only on Bloomberg.
The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now still with us, Plurimi Chief Investment Officer Patrick Armstrong. Patrick, I know we've spoken about luxury in the past, and this is actually our big number today, the fact that so much was wiped off the luxury market when Richemont yesterday said that inflation was really starting to take a hit. I mean, we thought they were immune. Right? What's this big number? $25 billion of market value lost in 24 hours in European luxury stocks.
Yeah, I think it's probably an overreaction. So I came into this year and that was my biggest theme, and we lightened it up in March just because they all went up 40% for us in the first 3 months, and it was a play on China reopening, disposable income, and pricing power, because input prices very small versus what they sell. And it still makes sense to me, that case. I don't see how input prices really impact Hermès, LVMH. Richemont highlighted it. But I think the U.S. consumers also weakened on the high end versus expectations. China, even though China has been disappointing as a whole, the Chinese consumer has done what you would have hoped for, I think. So I haven't reinitiated going back overweight luxury, but it's something that I'll be looking at again now because the multiples, again, make sense. LVMH, we bought it at 22 times earnings last September, sold it at 30 times in March, and it's back down. It's not back to 22, but it's mid-20s again, and I think it deserves a premium multiple, and input prices clearly are not irrelevant, but they're not going to be that material either.
And so you prefer an LVMH to a Kering or a Richemont?
Hermès is the one we own still,
yeah.
And LVMH is the one we had and sold, and that's probably the one I would get back into. I think.
Why?
I like their multiple makes sense to me. They're the dominant player. They definitely have the pricing power across all segments. It's Hermès trades at the premium multiple. The leather goods is really strong. But yeah, before I buy it, I'll compare and contrast them. They're much of a muchness, but LVMH, the dominant position there, I think is the one that my bias would be to.
I like that, much of a muchness.
Yes.
What do you do with a lot of retail stocks that are maybe in the squeeze middle? So not the discounters.
Yeah, so I don't own any of them. I own Amazon, which is a retailer, obviously, which is taking market share from everyone else. We don't have a single retailing stock in the portfolio other than that, actually.
They look cheap.
They look cheap, and for good reason. I think you do want to have pricing power. Don't think you want to be exposed to disposable income so much going forward. Unemployment's starting to tick up. I think we are in a soft landing in the U.S., but in Europe it is going to be continued tight purse strings, I think. So it's they don't look cheap enough for me yet.
Yeah. Patrick, I don't know how much time you spend not looking at technology per se, but actually cybersecurity, because when you speak to a lot of chief executives, apart from foreign affairs, something happening in Taiwan, they always point to cybersecurity.
Yeah, and the companies haven't been really guiding higher. Like Fortinet really missed. They had a number of large contracts that were deferred, and it's questionable whether they come back in. So the big picture makes sense, but somehow from the bottom up, it's not translating into massive revenue growth yet. So I don't see why not. I'm surprised it hasn't. But yeah, the bottom-up company specific guidance isn't showing the strong growth that you'd expect.
Is there something else that may be related to Japan? I mean, this is the big unknown, right, in the next 8 months, and what they do with yield curve control. I know I ask you every time.
Yeah.
But is there a way of playing that?
Well, I'm short Japanese bonds, and I don't have a short yen on. If they keep the yield curve control, you've got to short the yen. I think they're going to continue to loosen it gradually, and it's just too big of a differential versus where the U.S. is, where the U.K. is in terms of interest rates. You can't just going to be a funding carry trade, and they have to get rid of that. I don't know what the limit is, but they own more than half of bonds outstanding already. That just creates a natural limit there. So short Japanese bonds makes good sense to me.
Patrick, I know I spend quite a lot of time thinking about why the market is discounting, or at least ignoring what's happening in Ukraine, between Russia and Ukraine. Is there something that needs to happen for the market to price it in, or is it just an almost unmeasurable risk?
I think it's discounting things. It's definitely, it's very hard to do. I think the next impact for markets will be more and tighter and realistic sanctions that are actually imposed on energy from Europe, because you can't be importing oil and gas from Russia given what's going on. I think that's the move, that there will be political pressure and political will to actually enforce in the coming quarters.
But I guess what we saw in some of the soft commodities, or commodities in general, that's played out largely, or are you still expecting some tectonic shifts?
I think owning soft commodities makes a lot of sense for a lot of reasons. You've got Russia, Ukraine, you've got climate change, you've got droughts, you've got flooding, you've got population growth, higher incomes per capita. All of that translates into more meat consumption, which is very grain intensive. So it's not that people are eating more grains, but as you move from grain-based diet to meat-based diets, 25 kilograms of grain to get 1 kilogram of edible beef. So you've got a multiplier effect. So all of those things lead to, I think, soft commodities spiking higher on moments where there is an exogenous shock and drifting higher over the long term. So I think it's a play that makes sense in the long term.
All right, Patrick, as always, thank you so much for joining us. Patrick Armstrong there, Plurimeet Wealth Chief Investment Officer. Now, coming up, embracing technology to ensure democracy, legitimacy, and resilience. Bloomberg Original speaks to the Estonian Prime Minister about harnessing the transformative power of technology. That interview is next, and this is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful, because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising?
Yeah,
New York
the
City?
mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, the big story today is, of course, China seeking to broaden its iPhone ban to state firm and agencies, and you can see pre-market Apple down almost 2%. And Estonia's Prime Minister shares how governments can strengthen democracy, legitimacy, and resilience by embracing technology, all while facing an aggressive neighboring state. Well, Kaya Kallas spoke with Bloomberg Originals host and executive producer Azim Azar.
What do you do as a forward-looking government in terms of addressing the risks of AI, the questions that need to be asked of it?
We see this on the European level, that we could use or diminish the administrative burden by using the AI.
So you see there's an efficiency opportunity.
Absolutely.
But there's still this problem of the idea of the black box, the idea that there's some creature that is making decisions about my life that I can't perhaps inspect.
We can't pretend that this is not coming, so we are ignoring this. No, we don't do that. But at the same time, we are very cautious of over-regulating, because if you start to regulate in a very early phase, then you focus on the incumbents, because this is what you know. And, oh, okay, this way it operates. But every time you focus on the incumbent, you actually make the rules that are made for the incumbent and not for everybody else.
Yes.
So the balance question is about the, how to not kill innovation at the same time addressing the risks that there are. European Union is focusing, trying to get all the risks, and I think that is not finding and striking the right balance.
Estonia Prime Minister Kaya Kallas there on our new show, Exponentially. Now, the other thing we're looking at, of course, is what's going on in markets. It's a big day for markets because of China and also some of the repricing on what traders are expecting the Fed to do for the worst performing sector in Europe. We have mining. We also look at some of the fresh stimulus commitments from China. That could probably not come at a better time, but doing little to boost some of the European stocks. In fact, stocks 600 basic sources been on the retreat for most of the year, down nearly 15% since then, and that's more than any other sector in Europe. Coming up, crumbling concrete and the cost of childcare, a deep dive on the trouble facing the UK government as Parliament returns from its summer break. That's still ahead, and this is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. and they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg.
Good morning, everyone, and welcome to Bloomberg UK, a special focus on the biggest challenges facing the British government, the economy, financial services and markets. I'm Francine Lacqua here in London. Now, the British Parliament has returned from its summer recess to face a new problem, and that's crumbling concrete at schools. More than 100 schools were told to close buildings days before the start of term due to safety concerns, and it means thousands of children have been unable to return to lessons after the holidays. The government's not only facing questions over infrastructure, though. The Chancellor's plans to tackle the high cost of childcare have come under criticism, with the early years sector saying the measures are unworkable. The UK is one of the most expensive countries for preschool childcare in the OECD, and mothers of young children are also having to weigh the economics of staying in the labour force. In fact, the UK's economic inactivity rate has ballooned, with some 5.2 million women actually falling into this category compared to 3.7 million men. Now, more than a quarter of those women say they're jobless because they're looking after family or their home, and often it's because it doesn't make financial sense to work. Now, lots to talk about with the chief executive of the National Day Nurseries Association, Purnima Tanuko, also with me, Bloomberg's Olivia Konuti-Ahulu. So thank you both for joining us. Olivia, you've done some great work also in trying to explain, first of all, this crumbling concrete, which everyone's talking about, which is frankly quite shocking because some of these buildings weren't really kept up to scratch. First of all, who's the responsibility of having seen this and made it easier so that kids could go back to school this September?
Well, in terms of whose original responsibility it is, I think it's quite a difficult question because it's been a long-running problem, which has kind of been several governments. But I think Rishi Sunak, in particular, has come under criticism because there was a point where he was asked about funding for school buildings, and at that point, I think it wasn't expanded as much as it could have been. And when it comes to responsibility now, I think there's a kind of this rush to get kids in a safe environment just as schools begin again. So obviously, it feels quite urgent.
Yeah, and this is on top of, the childcare costs going up and up and up. Purnima, so you basically represent some of the day nurseries across the country. What can you tell us about how difficult it is to keep some of these nurseries open and how difficult it is for parents across the board to afford them?
I think it's been very difficult for nurseries to keep open because we've seen 50% more closures compared to last year at the same time as last year compared to here. And I think primarily the three reasons really, because the government has been underfunding the earliest funding for a number of years. And of course, it never kept up with even cost of living increases, like living wage, minimum wage, and all those other increases. And on top of that, the hourly rate that the government pays providers to deliver that high quality is not even covering their costs. So a combination, of course, workforce crisis, people are leaving the sector, and that's causing most problems.
Over the last 12 months, how many nurseries have had to close because of it?
Over 500. And even the regulator Ofsted figures also confirmed that. That means number of childcare places have been reduced. But I think, closures of nurseries is really devastating, not only for the parents, but for the community as a whole. So they're not able to sustain themselves.
Yeah, nursery closures with cost of living crisis, cost of nurseries going up, and childcare often means that one parent maybe needs to stay at home. Often it's the case that it's the mother that's the case. Are things going to get better, Olivia?
Well, the thing is that when Jeremy Hunt kind of announced these childcare reforms, he said it was so that he didn't want any parent to not work because of barriers to childcare. But then the problem was, as Benima just said, that the costs that the government are giving providers to meet kind of more subsidised places is not meeting the real cost. So in some cases they're being forced to put prices up. So it's kind of this vicious circle where, in theory, things should be getting better and there should be more affordable childcare being rolled out, but it's the costs, but providers are still having to make things more expensive, basically.
I mean, anecdotally, it feels actually like it's harder in the UK than other countries. Is that why?
Well, I think if we look at the OECD statistics, that shows that as a proportion of wages, childcare costs are pretty high, and that's, I think, partly because I think I was seeing in the report that taxes are high, but then in the UK, but that's not necessarily rolled out in terms of childcare benefits in the same way. And also the system is really complicated, so sometimes there are ways of getting subsidies, but parents don't necessarily know about them or kind of know how to apply for them.
First of all, is the government taking it seriously? I know that they've talked about it, but do you think they're doing enough in trying to really put it as one of the main issues that they want to tackle?
I think they say they're taking it seriously because the Prime Minister and the Chancellor announced a huge expansion from next year, 2024, for 2-year-olds. All 2-year-olds will be able to get government funding, and 9 months old from year after. But I think the issue here is the problems are here and now, and they need to fix those problems because with all the cost increases, 80% of childcare in this country is delivered by the private and voluntary sector. So they really need to address the workforce crisis and the funding problems before any expansion can actually work.
There's always a timeline problem.
Yes.
That even if they put money to the cause, how long does it take for some of these bottlenecks to actually get reabsorbed? How long, it takes years to open a nursery.
Absolutely, it does take planning, and I think that's why we were quite surprised when the announcement came in the spring budget, because even local authorities are saying they haven't got enough capacity to be able to deliver this policy from next year. So that's going to be a big challenge, and of course, you can't recruit staff overnight. It takes a long time to be able to recruit them, train them, and to be able to deliver that high quality. So it needs proper planning and a workforce strategy.
Yeah, Olivia, do you see a real commitment from the government, not just to talk about it, but to do something about it?
Well, I think the people on the ground are probably best placed to say that. And I think, like I said, it was difficult in March when they had this massive expansion of this massive package of childcare reforms, and I think they almost doubled the amount of money allocated to it. But there's a sense that it still isn't enough, and the shortfall has been the case for so long that, as Benima was saying, that the catch-up is just very difficult to kind of account for. So.
But is it a money problem, or is it an allocation of the funds problem?
I think both. I think I've definitely talked to people who have said that other nations, we spend a similar amount as a proportion of our GDP to other nations, but how it's spent could be allocated a lot better. But as well as that, I think, again, there's a shortfall between the subsidies which the government is offering and what it actually takes to deliver them, and that's also an issue.
And through all of your reporting, which I have to say has been fantastic, you also did a huge piece, of course, on the NHS and some of the funding crisis. Is it the same with some of the childcare costs, that it really depends also on where you live in the country?
I think it can do. So again, a lot of people have been calling for more funding to go to more deprived areas, because as well as all the problems which we've been talked about, there's also just an issue with availability a lot of the time where parents kind of enrolling their child in nurseries before they're born, and they're still kind of being put in waiting lists. And that is a sense that if you're in a less well-off area, you're more likely to be in those positions and find it hard to find a place for your child.
Purnima, what do you need now from the government? More action.
I'm meeting the new minister this afternoon, and he's the 8th minister. That just shows the lack of continuity in terms of some of these policy delivery. And I think what we are asking for is actually fix the problem with the 3- and 4-year-old funding at the moment, because providers are losing £2.30 per hour on every child, and they can't sustain like that. And most importantly, work on a workforce strategy to be able to accelerate some of the qualification issues we've got and take those blockages, because otherwise we're not going to be able to deliver this policy.
So this is funding, right? I mean, you need more money. It's not, can they take it from somewhere to put it there?
Well, I think it's funding, yes, but having said that, all that funding is not reaching providers, because what the government is promising on average is actually not reaching providers, because it's passed on through local authorities. No. And we did a Freedom of Information request last year. £45 million of funding that is allocated for early education and childcare did not reach providers, because it's been spent in other areas of schools' budgets. So that can't happen when providers are actually closing down. And I think all the money should reach providers to be able to deliver that high quality.
Purnima, thank you so much. Purnima Tanuku, they're the Chief Executive of the National Day Nurseries Association, and Bloomberg's Olivia Konotia-Hulu stays with us as we take a deeper look at the growing challenges facing the UK government. This is Bloomberg.
The tag on the product may read "Made in the USA," but the sign on the CEO's door often says "Made in India." Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
The roof of Singlewell Primary School in Gravesend collapsed in May 2018. Thankfully, it happened at the weekend and no children were injured. The concrete ceiling was deemed dangerous and liable to collapse, and everyone knew the problem existed in other schools. Yet the Prime Minister decided to halve the budget for school maintenance just a couple of years later. Does he agree with his Education Secretary that he should be thanked for doing a good job?
Of the 22,000 schools in England, the vast majority won't be affected. In fact, in 2/3 of inspections of suspected schools, RAC is not actually present. And to tackle the 1% of schools that have been affected so far, the 1%, we are assigning each of those schools a dedicated caseworker and providing extra funding to fix the problem. In the majority of cases, children will attend school as normal, and the mitigations take typically just days or weeks to complete.
UK Prime Minister there, an opposition leader there in Parliament after the summer recess on the controversy around public infrastructure and crumbling concrete in some schools. Let's return to Bloomberg's Olivia Kunoto-Ahulu and bring in Bloomberg's Phil Aldrich. Phil, I mean, frankly, it's a disaster for the government. You have 100 schools that are closed. We heard there from the Prime Minister saying, like, look, this could take days or weeks, but no more, and schools were reopened. I mean, we had an incident at our school, and it took 3 months to put it back together. Like, and he's coming under pressure specifically because he was Chancellor before.
Yeah, and he's obviously being targeted because he was in charge of spending the money. But I mean, these issues date from before that, and it does suggest that there's been some degree of government incompetence in terms of preparing for this crisis properly. But the bigger issues, from the broader public finances, what the government can afford. I mean, they're going to have to put some money into this. It may not be in the grand scheme of things, may not need to be enormous unless the problem spreads to prisons, hospitals, and then you'll see that there's going to have to be so much rebuild and refurbishing work that it does get very expensive.
So, Phil, Parliament reopens, and you're a Conservative government member, and you think, right? Well, we have an election looming. We need to get to work. We need to prioritise what people care about. What's on their agenda?
So I think there's the sort of backdrop to this is the public finances. There's no money left, so they've got to basically generate growth because that's the best way to get the tax revenues. They need interest rates to come down so that they don't end up paying more on debt servicing costs, which is really taking a big hole out of their budgets. And they need to get people back to work. So the sort of back to work agenda that you saw in the March budget is very much about boosting the supply. So it's basically a supply side reform, like the childcare stuff is our supply side reform. So those boosting the labour force and getting growth in general have got to be their priorities, and hopefully with the supply side up larger, better, the economy in better shape, then interest rates could come down.
But if nurseries close and you can't find a doctor through the NHS, and this is also something that will impact, of course, Tory popularity at the next election, so somehow they need to try and fix it.
You would think, and I guess the thing is with schools is that it's such a physical manifestation of Britain crumbling quite literally in this case. And so with childcare, as we were saying, as kind of parents and kids kind of go back to school and that kind of thing, there is this question mark over whether the reforms which the government announced earlier this year will be enough as providers are kind of preparing to take them on board. Because they're going to be rolled out in April next year, or start to be, and there's a sense that providers just don't have the tools or resources to actually implement them fully.
Is there going to be a lot of shifting? For example, I mean, when you look at childcare costs, and we're saying it's a funding problem, but also maybe it's an allocation problem. Are there any quick fixes or medium fixes that they could do to try and make the situation a bit better?
Well, I think they've tried. So what they tried to do is basically the amount of parents who could access a number of free hours of childcare. They expanded that to parents, to families with younger children. But the problem is that requires a lot of money for providers to be able to do that at cost, and also a right amount of staff, and also just enough nurseries running. And those things are really kind of being crunched at the moment. So in terms of a quick fix, it's difficult to see how those fundamental structural issues will be addressed.
Phil, we had a big investor, and actually for the first time, I mean, he didn't say he loved investing in the UK, but he did say he preferred the UK in terms of fundamentals to Europe. Are things looking better economically? Yeah,
it's been one of those big issues that we've faced for quite a while. A lot of business leaders have been saying, the UK is in decline, and there's policy drift, which is putting off FDI. The signs are definitely improving. There's the Windsor framework, so there's this kind of pragmatism around Brexit. Now we've got the Horizon deal, which again is like this sort of confidence booster. Those small details do help. And actually, if you look at the business investment figures from the ONS for last year, there's been a big increase. The super deduction, which is this kind of tax incentivized investment policy, which was introduced, which came into effect a few years ago, but has been extended for 3 years. It does seem to have actually generated some investment. So there's a tick for that policy. It looks like when you look at the business investment numbers. So yeah, there's been a pretty bleak sort of backdrop for quite a while, but it looks like people are feeling a little more positive about the UK. And those revisions to the ONS, our GDP is better as well. You know, we've got
it's much better.
We found 40 billion down the back of the sofa somewhere. So you know,
there you go. It's stabilizing. We're no longer declining, which is very encouraging. Phil and Olivia, thank you so much. Olivia Kanoto-Ahulu, Phil Aldrich stays with us. We'll talk a lot more about the Bank of England and Governor Andrew Bailey saying that the fall in UK inflation will continue. We'll discuss that next. And this is Bloomberg.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. The markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Many of the indicators are now moving as we would expect them to move and are signalling that the fall in inflation will continue. And as I've said a number of times, I think will be quite marked by the end of this year. Further, I think we are much nearer now to the top of the cycle.
Well, that was Bank of England Governor Andrew Bailey there testifying. Now, for more on UK inflation and the economy, we're joined by Bloomberg's Lizzie Bird and Bloomberg's Phil Aldrich is still here. We like to say they're Bloomberg just in case they're from any other channel. Lizzie, when you look at what we heard from Bank of England, okay, so inflation's going down, but it's not going to go magically to 2%.
No, but we actually just had some more encouraging data from the Bank of England in the form of the inflation expectations numbers. So actually they came in below expectations, 4.8% in August. The expectation was for 5.1%. It's down from 5.4%. And as a result, traders have pared their bets for where they see rates peaking. So now it's 5.7%. It's the lowest peak rate since June. You've also seen two-year gilt yields down even further. So it does matter. Clearly, Bailey's words yesterday mattered to markets because you saw that pound drop even before the ISM data and the dollar story.
Yeah, so what does that mean for interest rates? That's it?
No, I'm not going to say. You're not going to say that's it. But I think markets. Well, yesterday we're still betting on another 2 quarter-point rate rises. So you'd expect another quarter point. I mean, I think the Fed did this. They started signaling that they were going to pause, and then they did one more. It's like, we're going to pause, but we're still tough. And there's this balance between making sure that markets know that central bankers are still on top of on the case, and not doing too much. And so, as he said, we're near the turning point. That sort of suggests that there's still going to be a little more.
Yeah, and I feel like last time, actually, we heard from the governor. He was really at pains in kind of getting a leaf out of Christine Lagarde's book. And that, look, maybe we're done, but we stay at these kind of interest rate levels. And so that could mean more pain for a lot of consumers and a lot of companies.
Yeah, I mean, you already had some more house price data this morning showing that house prices fell at the fastest pace annually since 2009. That's the Halifax data. Interesting on the international comparison, there was a note from Oxford Economics in the past 24 hours saying that they reckon the bank will cut rates many months after the ECB and the Fed. And actually, even though Andrew Bailey yesterday was quite confident in the resilience of the UK economy, he mentioned the ONS revision to the growth numbers. These economists are saying that they're not so confident in it. It's something that Michael Saunders, former BOE policymaker, has said to us, that you've had low growth potential in the UK since 2010, and even he, the former hawk, is saying that maybe it's time to stop hiking.
Yeah, because I mean, it's mortgages, but also I guess there's a lot of refinancing that kind of come towards the end of the year or into next year.
Yeah, and it's this lag in monetary transmission that is the big question mark in all of it, because so many people are on fixed rates. But I think that Andrew Bailey did acknowledge that in his testimony at the Treasury Select Committee. There was this clear acknowledgement that there is a risk of over-tightening and going too far and creating a recession, which echoes the scoop that Phil got, that the majority of Jeremy Hunt, the Chancellor's Council of Economic Advisors, are worried about that risk of over-tightening.
Yeah, and how do you find growth? This is the million-dollar question, right? The Chancellor needs to find a growth plan.
Yeah, so if you increase the supply side of the economy, then you relieve some of the inflationary pressures because we can grow faster, and there will be no pressure through the price mechanism. But the growth plan, as I was saying, is basically you need to increase the labour force, which they're trying to do with childcare, and then they did it with these pension reforms. And now this week they've actually introduced these slight alterations to the welfare system as well. It's clearly they're trying to get people who are maybe who can work from home back into the workforce, and they would otherwise be on benefits. So they're making measures, they're making efforts there. The whole EU friends with the EU again. That whole approach is definitely another kind of like confidence in investment side. So that could drive up growth as well. But I mean, they've got to be clearly focused on growth to boost this, and obviously this interest rate issue for the government. I mean, for mortgages, it's really hard, but it's pretty nasty for the government as well. It's expected to add 15 billion in 2028 or 2027, 2028 to what the OBR was projecting just back in March. Rate rises are really hammering the budget.
All right, thank you both for some great analysis. Phil Aldrich there and Lizzie Burden. Now, also be sure to subscribe to Bloomberg's In the City podcast that I host along David Merritt on Apple Podcasts, Spotify, or wherever you get your podcasts. New episodes drop every Thursday. And today we talk about rethinking capitalism and some of the things maybe that the UK government could learn from Apple. Bloomberg Surveillance Early Edition is next. Janali Bazak in New York, Danny Berger here in London, and this is Bloomberg.
DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. and digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth the 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Could face bigger challenges. What's next?
Fed was going to keep rate World Cup. This is a 3.
As the economic picture does.
Is it the OK's getting ready to make a decision?
Okay, so you're moving in on me, quick. Distracting me with your fancy hands. I'm going to deal with your knight because this is really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. Apple is set to face a widening Chinese workplace ban on the iPhone, a sign of growing challenges for the company in its biggest foreign market and global production base. Pressure on U.S. equity futures intensify, and the dollar rallies after a hot ISM report raises prospects of a Fed hike. And Texas declared its first power emergency since a deadly winter storm 2 years ago. The state's power grid gets tested again as temperatures soar. Welcome to Bloomberg Surveillance. You're watching the early edition. I'm Danny Berger in London alongside Shonali Bassick in New York. Shonali, a 1-2 punch yesterday. It was hot ISM. Today, it is Apple woes coming out of China.
A lot of punches for sure. It's the September slump, Danny, and we're looking at another day of a down day of the S&P 500. S&P futures looking down about 0.3% this morning so far. We're looking at some cooling of yields, however. A bid in the bond market finally. We're looking at a 4.98 handle on the 2-year yield, a change of about 2 basis points lower. We were above 5% yesterday. Once again, the dollar still on its rally. We will talk about this a lot today because this is seriously the story of the week. This is where you're seeing the movement in Asian currencies very, very significant. You're seeing the onshore Chinese yuan really weaken to the levels since you've not seen since 2007. So pretty historic moves we're seeing in the dollar relative to other currencies around the world. I also want to do a check-in on oil because you do have Brent crude hanging out still above 90. It's been there pretty much all week. It has been on a 7-day tear, but you are seeing some softening of Brent crude down now about 0.3%.
So, Shanali, at the very top of the show, we got breaking Euro area GDP numbers. I got to be honest, our excellent producers said to me, break them when they come. And I was kind of hesitant because they're just the final numbers. Usually, there's nothing dramatic. But in these readings, we've actually had a big revision down. Year over year for the second quarter, the Euro area economy grew 0.5%. Previously, it was 0.6%. It looks even worse month over month. An almost flat growth, 0.1% quarter over quarter. The preliminary reading was 0.3%, the estimate. So again, a story of European growth being worse than expected. Are we really going to get a hike next week amid that environment? The other big story that's moving European markets is Andrew Bailey testifying in front of Parliament yesterday, saying that we are near the end of the rate hike cycle. Is that another policy mistake, communication error that we had? Him saying the same thing at the start of the year. 5-year yields react down 6.5 basis points. We went from pricing a near certainty of a hike for the next BOE meeting to about 80%. Sterling, that also gets hit, down 0.2% versus the dollar. And finally, we are seeing a turnaround ever so slight in European stocks, basically flat, just up 0.05%, Shanali.
Now over, Danny, to the big story of the day. We have Apple falling in the pre-market, down about 2.5% as China seeks to expand a ban on the use of iPhones in sensitive departments to government-backed agencies and state companies. You see that sell-off gaining some speed, now down 2.7%. Joining us now is Bloomberg's Tom McKenzie to talk about what is going on. How much of a big deal is this, Tom?
Shanali, so for the context, yesterday we had the Wall Street Journal reporting that some government agencies would be restricting the use of iPhones, or at least asking their employees to leave those phones at home. Today, our own team at Bloomberg reporting on the fact that maybe China's state-owned enterprises are considering a similar set of restrictions as well. For the context, on some measures, China's government-backed entities, state-owned enterprises, employ 50+ million people. So you're talking about the population of about Spain for the context. Now, we don't know if this is going to be applied across all of these businesses, if it's going to be limited. We haven't had an official audit yet, but it could be coming down the pipe. Obviously, hugely successful, significant for Apple that has, 20% of its revenue share comes from the Chinese market. And of course, it still produces the majority of its phones in that country. So has the star fallen for Apple is a question. Is it in the sights now of officials in Beijing who are security obsessed?
Not unrelated, we had that excellent Bloomberg reporting from a few days ago that Huawei phones contain chips that seem to violate sanctions, specifically SK Hynix. They had a release today about investigating it. I mean, what did they say? I don't know how you kind of justify what looks like violating U.S. regulations.
I mean, this is a genuine question, isn't it? Why does it come down to excellent reporting from Bloomberg for not just the White House to respond, but now SK Hynix to say, oh, hang on a second, why are our chips in these phones? Because, of course, the U.S. has imposed these restrictions and these sanctions. SK Hynix says that it complies with them, and therefore, as a result, it should not be seeing its own chips in these Huawei devices. Bloomberg did a teardown. It found these devices, the only foreign component within the Huawei phone. It's possible that Huawei was stockpiling and they had a pile of these chips that they could go to. They've done that in the past to try and offset some of these restrictions from the US. That may be the playbook, or these chips are getting in through another route. But yes, SK Hynix saying they are now taking a look at exactly how those chips got into that Huawei phone.
Right, and just affirming to Bloomberg, we are abiding by the U.S. government's export restrictions. Tom, thank you so much. Tom McKenzie there with the latest on tech abroad. Now, the Fed's Beige Book showed us that growth in the U.S. and jobs slowed in July and August. This came after an ISM surprise that put the Fed rate hike back into play. Former St. Louis Fed President James Bullard spoke about whether another increase is in the future.
It's probably wise from a risk management perspective and probably necessary based on the data that we've gotten that they keep that extra rate hike in there.
Joining us now is Bloomberg's Valerie Teitel. Valerie, the reaction was immediate. It was clear, stronger dollar, concern that maybe they're not going to pause, maybe they won't cut as much. How much do we read into ISM versus some of the other signals that we've been getting? Because this is just one data point.
It is just one data point, Danny, but that ISM figure was all around hot yesterday. The headline came in above expectations. And then the three subcomponents also, the employment subcomponent, the prices paid subcomponent, and new orders all came in hot. That is why the market had such an impressive reaction yesterday to the ISM print. Now, we do have to weigh it up with what we saw in the Beige Book. Now, the Beige Book did upgrade their assessment on growth to modest, which is an uptick, but it came along with some pretty healthy warnings about the U.S. consumer, and this is really front of mind for the markets at the moment. How do we weigh these early warnings we're getting on the U.S. consumer with the fact that we're still getting data coming in hot? And Danny, it is going to play out in the next Fed decision in 2 weeks' time. Remember, we get their all-famous dot plot, my favorite dot plot. A lot of attention is going to be on where the 2024 dot goes. Do these Fed officials revise their dot higher in a signal to the markets that they do intend on keeping rates higher for longer? We're also seeing some movement in the front end of the curve after that ISM print. We're now pricing over a 60% chance that the Fed does go ahead and hike one more time by the November meeting.
I'm glad you brought up the short end of the curve because you did see that pretty significant jump yesterday, but you are seeing that retreat a little bit today. There is still some volatility in the market now. How much are expectations changing heading into next year as this data keeps coming in so hot?
Look, Sonali, we have had the data this week, yes, but going forward, it's going to be about the final Fed speak that we get tonight. We hear from New York Fed President John Williams, who is speaking to Bloomberg. Now, this is important because last time he spoke, he talked openly about the fact that rates may be lower next year. The market is going to be very interested if he continues to keep that line, or does he shy away from talking about rate cuts, possibly signaling that he does maybe amend his comment from a month ago and does believe that rates have to stay higher for longer, and maybe his 2024 dot will shift up in 2 weeks' time.
Our thanks to Bloomberg's Valerie Teitel. Now, Texas has declared its first power emergency in 2 years as soaring temperatures almost led to rolling blackouts, with consumers curbing power usage. Now, joining us now is Eddie Vander Walt of Bloomberg Markets Live. You saw a very significant change in power pricing on the heels of these concerns, these blackout concerns. How much of an issue is this for the power market?
Yeah, absolutely. Look, it went straight from no warning to a level 2 warning. They jumped over that level 1, and that's because shrinking supplies have pushed their grid to critical levels, and they've been warning people to stop charging their Teslas and turn off the air conditioning and other things. And I think really though this is worrying, because what we're seeing here on a micro scale in Texas is something that we're going to talk about on a global scale. If you rely more on wind power and you rely more on sunshine for your grid, and at the same time you increase demand so much that we're shifting our whole vehicle fleet to electrification, then you're gonna struggle, right? You're gonna struggle to keep up unless you invest heavily in utilities. And at the moment, few people around the world are doing that.
I mean, it happened here, didn't it? Was that last year? I actually can't even remember a time when we didn't have wind in the UK and then power prices went crazy.
Yeah.
Okay, the next obvious thing that comes out, because of course we got to make it macro, is inflationary pressures. Already, gasoline is moving higher in the U.S. Does that compound that, or is it just, okay, this is a very specific market in Texas, it does not feed into the American inflationary picture?
The problem is that, yes, it's very specific to Texas, but if you see volatility in power prices across the board, then hedging power prices becomes more expensive everywhere, right? And that means that whether this is happening in Texas or whether it's happening in New York or whether it's happening in London, and all of these places are to some extent prone as we move forward, you've got to hedge in higher power prices longer term, and that means that it feeds through into actual prices, right? So I think this is a problem, but I also think that power companies are going to have to invest a lot more in utilities. That means they're going to have to charge customers now more for future for current demand in order to supply their future needs. And I think for that reason, I think it's a very good point, Danny. I think this does potentially feed through into inflation.
Yeah, we're going to be having that EV conversation later in the show. Eddie, thank you so much for joining us. Eddie Vander Walt there with the latest. Now, coming up, China's commodities imports pick back up as export slumps ease. We're going to take a deeper look on the China economy next. And it is a close call for next week's ECB decision. That's the view from RBC Blue Bay's Mark Dowding. While the market has decided it's a sure thing, it's a pause. We're going to discuss that debate later this hour. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Today, Bloomberg's Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out today at 3:30 p.m. Eastern, only on Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Shonali Bastick is in New York. China's trade slump eased in August. It adds to early signals that the worst may be over for some parts of the world's second largest economy. It is in this moment where it's trying to regain momentum. Joining us now is Bloomberg's Shenzhen Bureau Chief Alan Wan. Alan, so we got this trade data. Does it tell us enough in terms of stabilization? Are we there yet with China's economy?
Well, I don't think we're out of the woods, but it's really whether or not you think like the glass is half full or half empty. But a lot of people are looking at the data quite positively. Exports, even though exports fell for 4th straight month, the pace of declines has actually narrowed quite a bit. It was much better than expected, and also a big improvement from the previous month. And we saw the same thing in imports. And the reason why you might think that the Chinese economy may be improving as well is that this comes after last week's PMI data, which also showed an improvement for manufacturing. Most notably, in this latest data, we also saw that Chinese exports to the U.S., the pace of declines have also moderated as well. And in South Korea, which is often a bellwether for global trade, we're seeing the same kind of moderation in terms of declines for exports. So I think that overall things are improving.
Whether you look at the actual exports themselves and then pair that with what's happening with the currency, how much of an issue is the currency movement, and what factors will the trade improvement really hinge on at the end?
Yeah, I mean, that's a great question. I think with exports, it's a little trickier, right? Just because a lot of economists have a fairly, neutral or negative outlook for global trade this year. But in terms of imports, there's a lot of potential there. I mean, a lot of people see a rebound in domestic demand, especially now that the Chinese government has launched a lot of measures to support the property market. That said, though, you talk about the currency, the onshore yuan fell to a 16-year low against the dollar today. And we know that a weaker yen will inevitably lead to more expensive imports. So that's definitely something that could undermine the picture for imports and overall trade.
Yeah, fair enough. Alan, if this iPhone ban goes further, and let's say it goes far enough maybe to spook some of the development of iPhone equipment, Foxcons, the world, that sort of thing, out of China, how big of an impact would that have on the economy? Because presumably there's got to be some part of that calculus in China's moves to tell government officials and those at state-backed companies to not be using iPhones.
Yeah, I mean, one thing is the move, right? You know that Apple is a big employer in China, and Apple, sells tons of their phones in China as well, and that's one part of it. The other part is that what kind of signal does it send to foreign investors that we keep hearing the government is opening the economy to foreign investors, don't worry about all these recent actions, but from the looks of it, it just seems that it's more of the same. China, maybe under the guise of national security, is taking measures that look like it's becoming much more, maybe isolated from the rest of the world, taking measures that maybe for its part it believes it needs to do so for national security, but it's going to continue to spook foreign investors who are hoping that, especially China's relationship with Apple continues to stay afloat despite, increasing U.S.-China tensions.
Bloomberg's Alan Wan, we thank you for your reporting from Shanghai. Now from China to India, ahead of the G20 summit, Bloomberg's Menaka Doshi reports on the country's economic transformation.
India is the world's second largest phone market, over 200 million sold last year. A decade ago, most of them were imported. Now the country is a net exporter, with Samsung and Apple leading the charge. Prime Minister Narendra Modi wants to repeat this phone success across electronic goods, electric vehicles, green energy, chemicals, textiles. The near-term goal is to reverse the declining share of manufacturing in GDP, targeting $1 trillion in goods exports, and most importantly, creating jobs for the largest working-age population in the world. But standing in the way of this manufacturing ambition are some old challenges: land acquisition problems, high logistics costs, and some new ones as well: automation, lack of skilled labor. Take phones, for instance. The government has implemented a mix of high import tariffs on finished phones and production incentives to boost local manufacture. But supply chain indigenization is a long way off. According to one report, Indian factories add 18% in value to the electronic devices they assemble for export, compared with 38% in China and 24% in Vietnam. Manufacturing in Vietnam is also cheaper by at least a tenth. The Make in India campaign will benefit from record investments in infrastructure and logistics. There's also the lure of a potentially large domestic market. And now there's the China Plus One wave, as large global corporations seek to mitigate geopolitical risks and a slowing China economy by diversifying their supply chains. Since the liberalization of its economy in the 90s, India has come to be known as the back office to the world. But to become a developed economy, the government also needs it to become the factory to the world.
Bloomberg's Menaka Doshi there reporting from Mumbai. Coming up, bidders including Boaz Weinstein are said to be revising their offer for Sculptor Capital. We'll have more on that Bloomberg scoop next. This is Bloomberg.
What's happening on Wall Street?
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Surveillance Early Edition. I'm Shonali Bassick in New York with Danny Berger over in London. Now, some of the top stories we're watching this morning include bidders, including Boaz Weinstein, offering to buy Sculpture Capital, are said to be revising their offer and addressing some of the concerns flagged by the board. That's according to a Bloomberg scoop. Weinstein's bid remains the same, but he's beefed up his equity commitments and eliminated risks related to debt financing.
And Soho House is expanding in America. The Private Members Club is planning to open 6 more locations in the U.S., including in Portland, Charleston, to have 20 houses in the country by 2025. Speaking to Bloomberg, CEO Andrew Carney highlighted post-COVID opportunities as Americans move out of large cities. Shelley, I don't know what it's like there in New York right now, but I swear you can't throw a stone without hitting a Soho House or a Soho House member in London right now.
Now, remember, they also have ownership over the Ned, too, which is also open in New York City and is pairing up with Michael Milken to open a location in Washington. Now, will all of these locations be successful? Certainly, the backing from other billionaires certainly helps.
Now, I say this as someone who was born and raised in D.C. If you're trying to remain a cool artist, kind of, I don't know, interesting alternative kind of company, D.C., I don't know, Shonali. I don't know. I mean, again, I am really lame and I come from D.C., so make of that what you will.
You know, I'm from around the area, too, so it is interesting to see these pop up like little diamonds all over the place. But, you know, speaking of how it's trading, the investor perspective, this is still a stock, Danny, that is trading almost half of its IPO price since 2021, and it's doubled this year, but it is still a long way to go from where it started.
And look, you know this probably better than anyone at Bloomberg, Shonali, the real estate woes that have been gripping the U.S. So much of Soho House is tied to that. I mean, they are working at some really expensive properties. The Ned, for example, in the U.S., all of that, I mean, a lot is at risk here if some of that property starts to downturn. A lot of leverage at stake.
I'll speak from personal experience. They've been throwing some massive parties in New York City.
All right, coming up, we're going to be speaking to Mark Dowding, CIO of Blue Bay Asset Management next. This is Bloomberg.
Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years, adding to an incredible run in which Berkshire shares have returned more than 3,000,000% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway, its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. But it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run.
Bloomberg Surveillance Early Edition, and here is what you need to know. Apple is said to be facing a widening Chinese workplace ban on the iPhone, a sign of growing challenges for the company in its biggest foreign market and global production base. Meanwhile, pressure on U.S. equity future intensifies and the dollar rallies after a hot ISM report raises prospects of a Fed hike. And then in Texas, it declared its first power emergency since a deadly winter storm 2 years ago. The state's power grid gets tested again as temperatures soar. I'm Shonali Bassick in New York with Danny Berger over in London. Danny, what's the European market doing today?
Look, we are still trading, at least in UK assets, based off of some comments from Andrew Bailey, the BOE governor, yesterday. He talked about this idea of maybe we have hit the top in the cycle, that we are there. Dangerous comments, considering in January he had said that they turned a corner in inflation, and we know what's happened since then. But that is how the market is trading. 5-year yields in the UK, gilts down by about 9 basis points. Sterling, that continues to drop like a rock. We're now at 124. That's down weaker by 0.2% versus the dollar. Some of the rate hike bets for September paired back too with those dovish comments. They were above 90. Now they're around 80% that we're going to get a 25 basis point hike. Equities, though, picking up a little bit of steam here in Europe. Europe Stock 600 up 0.25%. A solid turnaround, though, from the start of the morning where we were trading lower. Shonali, how's the U.S. looking?
Not as good. So you're looking at the S&P future, still down another day. It is just not catching a bid yet, Danny. Sad September. But we are catching a bid, however, in the bond market. I've been watching the 2-year yield all morning, and you are looking at a hanging around 498. Now, listen, that is about 3 basis points lower in terms of its change from yesterday. Again, a bit volatile this morning, but we are back in the bond market. We are also looking at the dollar. This is the big story. We are watching the velocity here in the U.S. dollar and the rate of change against foreign currencies. We will talk a lot more about that in this coming block. And Brent crude now back below 90. We are looking at an 89 handle, very close to 90 still, though. It is down on the day now, 0.7%. Now, we are also going to talk more about that dollar index. Like I promised, it's on track for an 8th consecutive week of gains, putting it on track for a historic run. And that's according to data going back to 2005. Now, Asian currencies weaker. The onshore yuan weakened to a 16-year low. That's the weakest level since 2007 against the dollar. The PBOC's will is tested, and traders are watching the PBOC closely for fixing on where it it will draw the line. The daily reference rate was set at a stronger than expected level for a 54th straight day on Thursday. That is the longest streak since Bloomberg began its survey in 2018. Now, to talk more about this is Mark Dowding, perfect voice for this conversation, CIO of RBC Blue Bay Asset Management. Mark, when you look at that surge in the dollar, when you look at the weaknesses in Asian currencies, what are you most concerned about given where positioning is in the market right now?
So I think a lot of the move that we're seeing here on the dollar has been very much supported by the fundamental backdrop. We're seeing certainly a return over the last couple of months of US exceptionalism. And just as the US economy continues to plow forward pretty strongly, I'd note that the Atlanta Fed nowcast for Q3 growth estimates is running north of 5% in the current quarter. So you're still looking at really pretty robust US activity at a time when activity elsewhere in the global economy is slipping. And certainly that's been the case in Europe. It's also very much the case in China as well. So we can see that these trends have been justified. I guess my only concern here would just be the fact that this is becoming a bit of a consensual view now. People have been sort of jumping on the long dollar trend. And obviously when investors all get the same way on a trade, then maybe it's time to start booking a few profits, perhaps.
Right, when you have crowded trades, there's always that risk of a bubble. And you have the dollar defying gravity. You have oil prices on the rise. What is the risk that soft landing narrative really faces some pressure?
So in terms of the soft landing, at the moment, I'd say that in the US, you're not seeing a landing at all, are you? I mean, I don't think we can really talk about a soft landing at the moment because we don't really see growth slowing down ever so much. The other thing that I'd also point to as being a bit of a risk here is the trajectory on inflation. I think we've done the easy part of the journey, bringing inflation down from 8% to sort of 4% sort of levels. But we're now going to be entering into the more difficult sort of last mile, trying to get inflation all the way back to central bank targets at 2%. That's going to be a more challenging stretch. And actually, in the near term, the fact that we've actually seen oil prices moving higher, we've seen commodity prices more broadly moving higher, means that when we actually model forecasts for inflation over the next couple of months, we actually see inflation sort of not really sort of joining the party and moving much lower. And indeed, sort of having spent time in Europe this week, there is clearly a bit of a sense looking at European data that over the course of the coming 6 months, we're going to be seeing weaker growth outcomes, but we're not going to be seeing much progress when it comes to inflation.
And then the Richemont chair also complaining that inflation in Europe means no one wants to buy Cartier watches anymore, Mark. It's a sad time. Look, all of what you're saying feeds back into the strong dollar narrative. If you think it's starting to get crowded and perhaps things turn, where are you willing to stick your neck out and take the other side of a dollar cross? Is there a pair you like to short the dollar?
So not so much at the moment. I think the currency that really stands out to me as fundamentally cheap is the Japanese yen. Traveling to Japan recently, you're struck by how cheap it is. By contrast, you go to the US and it's remarkably expensive. I had a beer in a bar in DC. It sent me back $16 when you allow for a service charge, and that was just for a regular tin of beer. By contrast, Japan used to be the most expensive place to travel on the planet. It's now one of the cheaper places to go. So we do think that the yen is interesting, but you really need to see more than comments from the Ministry of Finance complaining against yen weakness. You actually need to see the Bank of Japan come to the party and actually acknowledge that the goal in terms of delivering the end of deflation has now been achieved. And we're now going to be in a situation where yield curve control can come to an end. If that happens, I think sort of fair value for dollar yen is probably around the 120 mark. So there's a lot to play for there when the policy turns. But I think it's a bit too early yet. At the moment, for me, the narrative is starting to reduce some of the dollar longs that we have. but haven't really tried to flip the position and go the other way, just because the data still looks pretty much in your favor for the time being.
I got you there. So two questions off the back of that. First of all, I need to know what your izakaya order is, Mark. Second of all, does that mean that you've started to also reduce your max short JGB position, if we're not there yet, in terms of abandoning yield curve control?
No, so we continue to like the idea of being max short in JGBs. To me, if you look at core inflation in Japan, you're looking at inflation running at 4%. We think that at the October BOJ meeting, the next big quarterly meeting they have, they're going to be revising up their inflation forecast once again. And actually, it's well possible in our eyes that the Kishida government actually says we've achieved the target of bringing sort of inflation sustainably to 2% now. And that's actually the pretext for an end to YCC altogether at that particular meeting. Were you to see that, we'd expect to see 10-year JGB yields go north of 1%. And so actually being really short JGBs is probably the one sort of standout rates trade here that makes a lot of sense in our eyes. In particular, being short JGBs, it doesn't cost you a lot in carry, so you can actually afford to be a bit patient and sort of keep that trade on. With the yen, clearly it's more difficult. You're paying a lot of carry if you want to be long yen here, and so you kind of need to wait almost to the moment that the policy does flip before you actually want to put that position on. But I certainly think that Japan is interesting at the moment. In the here and now, I think that when it comes to US rates, Euro rates, it is a bit of a muddied water situation. It's a bit premature to be really jumping in and wanting to go long anywhere else. The one thing that really stands out as a good risk-reward trade continues to be a short in JGBs.
You think about the hedge funds that are short the dollar, and you think about the way that hedge funds are trading treasuries just alone, Mark, and I'm curious, the Financial Stability Board just a day ago had brought up, re-raised really, concerns around basis trading. These can be quite levered. Do you share those concerns?
So we see, I mean, levered basis trades here, but I don't think that this is really a big driver of concern around market stability. I actually think that you're seeing a lot of basis trading, partly because a lot of that macro community has struggled to make money in terms of directional trading in rates this year. Ostensibly, you look at macro hedge fund returns. I think the median manager is probably on a negative return, close to -5% on the year. We're doing all right ourselves, not having a spectacular year, but certainly a year which seems to be standing up much better than others. But I think one thing that you would sort of say here in terms of the investment community quite broadly is that a lot of people came into 2023 thinking the big trade was going to be buying treasuries, being longer duration. It hasn't worked, and it still doesn't work. And I'm a little bit cautious that there may be a capitulation at some point. If we did say, for example, a negative inflation print cause investors to actually give up on some of that long duration positioning in treasuries, I wouldn't be surprised to see another leg of a sell-off, maybe to sort of 450 on 10s as an area you might want to target more as a buy zone.
Mark, we have to leave it there. Would love to have you back soon. With all the currency volatility we are seeing, that is Mark Dowdy of RBC Blue Bay Asset Management. Now, coming up next, we're going to talk about a big investment that KKR is making. We'll talk to Zenobi co-founder Nicholas Beatty on a $1 billion investment that included the big private equity firm. This is Bloomberg.
Sports and money, they've always gone together.
But
Never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London alongside Shonali Bassick in New York. Now, UK power storage company Zenobē is set to draw more than $1 billion in fresh investment from investors. It's led by U.S. private equity giant KKR. So deal flow, it is still happening. Joining us now to discuss is co-founder Nicholas Beattie. Nicholas, thank you so much for coming on. Really great to see you this morning. Congratulations, new investment coming from KKR. Why? Why go to private equity here, and what's the hope with this new cash in hand?
Well, as you will have seen from the stories about us, we've expanded since we established the business 6 years or so ago, very rapidly, doubling our profits and our revenues over that period of time. And we're a very cash-hungry business, and we need a lot more equity so that we can continue to meet the company's requirements and build out the new different projects that we have already established, both in the network infrastructure side and on the fleet side. So this capital will be used to help us do the projects here in the UK, but also help us expand in Australia and New Zealand, where we have a presence, and also into North America, where again, with the assistance of KKR, who obviously has a very strong connection in that market, we will be working with our established customers to help them electrify fleets and also put in network infrastructure batteries.
Now, for a lot of green businesses, a lot of infrastructure green businesses, we still have kind of the COVID hangover effect of things that are still too expensive. I know a lot of European wind turbine companies, for example, still have parts that are delayed coming in, too expensive. What for you is still too expensive? What for you and your business is still giving you a headache?
Well, the first thing has been, you're right, COVID has been incredibly difficult. I mean, we established this business in 2017. That's when we started operating. And obviously through the first parts of the business's growth, we were finding it very difficult to find the right people. I have to tell you, as a business now with 240 people, we have 22 different nationalities in it. We're very proud of that fact. We've been through periods where it's been very difficult to get the right level of supply. So I'll give you an example. You're very aware of lithium carbonate prices last year went up quite substantially towards the end of the year. And that had caused a huge sort of impact on the cost of the supply, particularly of large batteries, also the batteries that are going on the buses that we finance and operate. We've seen that come down now more recently into this year, and indeed I think our feeling is that there's quite a lot of the EV demand which is sort of coming off, hasn't gone as expected, and so there's more availability of batteries, and we're seeing the price associated with the batteries therefore drop. So there's always these sort of shifts and balance. The other one that you'll again be aware of is the semiconductor problems that we had with Taiwan. If you're building a bus, you have to put a number of semiconductors on that vehicle. A lot of our software goes onto those semiconductors to monitor things. So we had quite a lot of problems with them, and we're pleased to see that that seems to have been resolved now.
What are some other problems with electrification? You think about some of the biggest spenders and some of the biggest promises that have been made by governments around the world, and then you think about how bloated the government balance sheets are and some of the rollbacks and plans. Germany, for example, scaling back its target for 1 million charge points by 2030, for example. How much are local obstacles a problem?
Well, that's a very interesting question because, frankly, we see that the government putting money into the industry is a bit of a two-edged sword because, obviously, if there are, for instance, in this country, as there have been with the Zebra grants, if there are grants available, then the commercial runners of buses will stop making decisions until they see whether they might be able to get those grants. So then they do get the grants and then everything starts going again. But it does mean that you get this sort of stop-start effect because of government putting money into the sectors. Overall, I think that we see that the government money is very supportive because definitely, as an example, a bus costs twice as much, an electric bus, compared to a diesel equivalent. So, you know, the operators need to be able to use that additional capital to reduce that so that over the through-life costs, it comes closer to parity with diesel. And we're very grateful for the support the government gives. But we do see, as we've done with solar, that there's more opportunities now to allow the market to develop, perhaps on a more commercial basis. As you say, the governments have got lots and lots of problems on their plates with where they want to put the capital that they have available to them. And I think a lot of these markets are getting closer to the point where commercial decisions can be made and where the opportunities to purely fund them from debt markets are there.
Speaking of commercial decisions, you think about the Inflation Reduction Act. How have you been able to take advantage of that in the United States?
Well, I love to be sitting here and saying we're taking advantage of it today. We're just getting into that market. We've got 7 people on the ground in the US. On the bus side, our largest customer here in the UK is National Express, and then you name, but they own 30,000+ school buses in Australia, and in the UK, and we're being taken into the North American market by them. So that's really positive. Yeah. And equally on the large battery side, we're also seeing opportunities to build projects there. Again, that will be supported by tax credits and things that are coming out of the IRA. So we're excited about that. And we see that as a definite opportunity to boost our growth in North America.
I wonder what you make of some of the backlash to some of the ULEZ expansion plans in the UK, because it feels like it's kind of taken on a life of its own. Are you concerned that that grows into something that potentially dents the uptake of EV vehicles and EV adoption, for example, by governments for buses and things like that?
No, I don't think so. I think that, you know, what we're seeing is that people recognize that the amount of pollution that's produced by vehicles, particularly actually buses and commercial vehicles, is a very large part of the problem. So I think while there are these backlashes, there's still the recognition, there's still a regulatory and a legislative requirement to meet the Paris Accord and various other accords. And they're also seeing at the same time, you know, people at younger generations who are going to court to say, you know, countries are not doing enough. It shouldn't just be the bare minimum. So I think there's a balance between the backlash and actually what needs to happen in the marketplace to remove these vehicles.
I suppose sometimes backlash is just loud. So
it's what it happens. It's what it happens, exactly.
Yeah. Nicholas, thank you so much. We really appreciate you taking the time on, I'm sure it's a busy day for you. Nicholas Beattie, thanks so much for joining, Zenobē co-founder. All right, coming up, we're going to have a look at some of the market-moving events to watch throughout the day, including an exclusive with New York Fed President John Williams. This is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present it with a plan.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Sonali Bastick is in New York. Now, a quick look at what's ahead today. Get you set up for your trading day. Canadian Prime Minister Justin Trudeau speaks with Bloomberg's Eric Schatzker. That will be at 6:40 a.m. Eastern Time after a hold from the Bank of Canada yesterday. Then we'll be getting U.S. initial jobless claims at 8:30. Then the FDIC releases its quarterly report on the U.S. banking system at 10:30. And then we're going to get a whole lot of Fed speak. That will include Harker, Goolsbee, Bostic, Bowman, and Logan all on deck. But hey, this is the important one you don't want to miss. It is Bloomberg's panel with New York Fed President John Williams at 3:30 p.m. Eastern Time. He's a man who rarely speaks to media and is very influential in the Fed, and we'll be bringing you that live on TV and radio. Sonali.
Danny, we're all looking at some stocks pre-market trading in the United States because Apple is taking another leg lower. Remember, China is looking to extend a ban across state firms and agencies when it comes to the iPhone. This is in addition to a Wall Street Journal report yesterday that said that several agencies began instructing staff not to bring iPhones to work. Bloomberg now reporting that they are looking to extend that ban. Apple now down about 2.7%. Now, Apple suppliers are also sliding on the report of this ban as well. This is a host of companies from South Korea, Japan, and Taiwan suppliers all trading lower on the news.
Yeah, and you got to remember, I mean, again, this is extending beyond just government employees, but state-backed companies as well. That's a large chunk, Sonali, of the Chinese population. We have to keep that in mind and just how impactful this will be.
Now, there's another stock I want to focus on. It's Tesla. Now, listen, Tesla is taking a leg lower this morning, 1.5% nearly. This is a stock that has doubled, so no one's crying for Tesla, but they did clarify during investor meetings in Munich that both production and deliveries will be down in the third quarter due to planned factory shutdowns globally. Deutsche Bank analyst Emmanuel Rossner wrote in a report. Danny, that does it for us for Early Edition. Before the U.S. market opens, surveillance. Bloomberg Surveillance is up ahead. We'll hear from Tony Dyer of Canaccord, Genuity, and Seema Shah. This is Bloomberg.
have been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted, and I think many people, even in the markets, have not quite understood, in my mind, how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
We wonder if the consumer is beginning to bend, not necessarily break.
I think the last thing consumers need at this point in time is a spike in oil prices and gas prices.
Does energy drive the economy, or does the economy drive energy?
Oil prices going up, even for a short time, just complicates this narrative for the Fed.
Figuring out when to stop the rate hike cycle is always a really, really tricky business for central banks.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Difficult, tough couple of days on the S&P 500. Futures lower again this morning. Apple front and center at the epicenter of our conversation this morning. Apple negative by 2.7% in the pre-market. Some reporting here at Bloomberg. Allow me to share it with you. China plans to expand a ban on the use of iPhones in sensitive departments, Tom, to government-backed agencies and state firms as well.
Yeah, there it is. It's a headline. The other one is that the 2 of my iPhones are broken at home as we get ready for the Apple meeting here coming up in next number of days. The Apple drawdown, John, is 8% from the recent intraday peak. Yeah, it's a pullback. But again, this has happened before, but I take your point. Is this time different? And I think it bears a lot of scrutiny by Mark Gurman and our team on the Pacific Rim.
You're right to mention September 12th. That's the iPhone launch. The new iPhone, the 15. China's really, really important. A fifth of revenue for Apple. And Bramo, it's not just this line. It's the competition you might get from Huawei as well. How difficult are things going to be in that country for this new launch?
Especially if you can tell that the authorities are not particularly on Apple's side and are actually working actively against them. You asked me yesterday, who has more to lose if the Apple-China partnership breaks apart? And I kind of hemmed and hawed and didn't really know. And I was looking at the millions of people that Apple employs and the ability of China to really reignite confidence in its international businesses and how much they're open to business. What does that do to this if they do really break in and erode Apple's position?
This goes to Catherine Mann now at the Bank of England and her arch work at Brandeis years ago, the codependency between America and China, the codependency of Apple with, I'm going to call it basically the Chinese labor model. And I think your point of millions of people involved is not off the mark. And John, you know, I wonder how much of the quote unquote government is going to be all Huawei and not iPhone. Do we know yet? I think the answer is we don't know.
Well, how much of the public will be all Huawei and not iPhone? That's the more important question for the likes of Apple. I also think from the perspective of Tim Cook, the diplomat, he's been phenomenal at that for years, being able to play both sides of that tension between the US and China. And clearly what this story, Tom, conveys is that China sees Apple as a US company. as a US company, which is why we're seeing those bans at the government level for staff in those agencies?
No, the answer is pull back. We're back to a level, I'm eyeballing it here, early summer level on Apple. They've had a hell of a run here over the last number of months. And the answer is we'll have to see. Again, my focal point here is how big is that government exclusion of Apple products? I don't think we know.
And does it spread? Does it stir up some nationalism, whip up that kind of patriotism?
Well, the nationalism's there already. There's no question. The anti-American sense is there, but they want their toy. They want their iPhone, just like everybody else in the world.
Equities right now on the S&P 500, more broadly, negative by 0.25%. Apple lower by a little more than 2%. So futures lower again. 2 days of losses on the S&P 500, down a little more than 1% over that period. Yields come in about a basis point on a 10-year, 426.59. Tons to talk about in foreign exchange. Just about holding on to 107 for the euro. Lisa, the euro right now, 107.14.
And Kit Juice coming out this morning and basically reiterating why even have it this high, considering some of the pressures on the euro. Today, what we're looking at, 8:30 a.m., we get initial jobless claims and non-farm productivity. 10:30 a.m., the FDIC is releasing a quarterly report in the banking system. I'm interested in that. But really, it's jobs, which is going to be front and in the focus. If the jobless rate is ticking up just slightly, where is it in the jobless claims filings, which have not ticked up in any meaningful way? Today, who isn't speaking on the Federal Reserve? I'll just give you this. Philly Fed's Patrick Harker, Chicago Fed President Austin Goolsbee, Atlanta Fed President Raphael Bostic, Fed Governor Michelle Bowman, Dallas Fed President Lori Logan. But the big event is John Williams, our New York Federal Reserve President, who is going to be speaking to our own Michael McKee at 3:35 p.m. in New York.
You missed the punchline. I'm the warm-up act.
Are you?
I'm going out there with Torsten Slok and a bunch of worthies, and we're going to talk about foreign exchange and global macro. And then they booked some guy after me called Bloomberg, and he's going to show up to introduce Michael McKee and John Williams. You know, I mean,
okay.
Talk about I'm the afterthought here.
Let me reset. Tom Keene will be speaking today, and you might want to pay attention to that. There also are some Fed speakers as well. Also, President Biden is going to be departing the United States to head to the G20 meetings in New Delhi. There are a couple things here that are really important. First, how much does President Biden take advantage of the fact that Vladimir Putin and Xi Jinping are not showing up? Does he sort of solidify the alliances there? And number two, what's that meeting with Saudi Arabia like with all of the oil output cuts?
Fist bumps and all that?
Well, you think they're going to be fist bumps?
No idea.
Anyway, that's what I'm watching today.
Looking forward to it. Tony Dwyer joins us now, Chief Market Strategist at Canaccord Genuity. Tony, wonderful to catch up with you, sir. Light and tight was the diet for you in the summer. Is it still light and tight? And what would it take to make you positive on this market?
Yeah, it still is, John. As you can see, I'm a little bit under the weather, but you know, you've got to have a dramatic improvement in credit. And I know the first response is anybody in our business is going to say, what are you talking about? Corporate credit spreads are tightening, but they're tightening mortgage spreads, corporate credit spreads. They're tightening because the 10-year is going up. They're tightening for the wrong reason. I cannot find a soft landing scenario, whether it's 1966, 1995, or any recession-based recovery. Any economic weakness is always associated with a significant sustainable drop in rates. That has not happened. The absolute level of rates remains high. And so as you guys know, I believe that the soft landing scenario is the worst case scenario because it keeps exactly what we're seeing. It keeps inflation elevated and it keeps the Fed higher for longer, which gives more time for resetting a debt to have to do it at a much higher level.
Tony, I look at where we are, and there's a paper merger going on now. I just looked at something called Smurfit Kappa Group out of Dublin, and they're trading at a PE of 10. I believe there's 7 stocks trading a little bit higher than that. I see minimal evidence of a broadening out of the Standard & Poor's 500 if we hold on or even if we advance into 2024. Do you see any ability of SPX to broaden out?
Well, it did for a little while over the summer. We had talked about the hustle of the Russell and, you know, had looked for a trade up to 2,000 on that index. The problem is, Tom, everything is temporary until you get that dramatic improvement in credit. Like, let's say the economy's okay. Let's say somehow it's going to mystically, after the fastest rate hike cycle in history, into a generationally levered system with quantitative tightening. Let's just say it's not going to impact anything. It's all good. How are you going to get, when you're already at full employment, how are you going to get that double-digit earnings growth next year? Now, some of it can come from AI and productivity. We get those numbers today. But real double-digit growth with flattish revenues is a really tough call when you're already at historically high margins.
Tony, you talk about light and tight and staying in that level, in that sort of protective stance, with the expectation that only if yields materially drop will you see something that's more constructive. What could make you that much less constructive on the other side, especially the soft landing scenario that you talk about, if it starts looking a little bit more likely?
Well, I just don't. Lisa, it would be so historically unique to see a soft landing here without a recession. Where I'll be wrong is if nobody cares that the recession's coming. Now, the reason to explain what light and tight means, it means have a little extra cash and be tight to the benchmarks. However, a little bit obviously more defensive based on my tone. But the reason it's not get the hell out is because so many stocks are already down significantly. I just looked at the S&P 500 department store sub-index. Holy cow. Like a lot of stocks already reflect the kind of economic outlook that I'm talking about. So the time to really be super negative, which we were, was last summer and last year when you knew the Fed tightening cycle was directly ahead of you. Remember, it starts out as good news is bad news because it means tighter Fed. Then bad news is good news. We've been in that. It means the Fed's going to stop. But ultimately, bad news becomes bad news. And when that happens, I want to attack the weakness versus trying to play it. So I think, just kind of staying out of the way when your earnings yield is below the risk-free rate of return. I don't have to guess, guys. We don't have to guess. You're getting over 5%.
Tony, I've got to re-listen to that to make sense of it all over again. Can you tell me what conflicting news means for markets? Because yesterday there was some tension between the beige book, which painted somewhat of a soft landing picture, slowdown story. Then the ISM said, boom, let's go. Tony, how much weight should I put on one versus the other?
So, John, that's a great question. So the bee in my bonnet lately has been that if you look at the establishment survey, and I got this idea from my friends at Med Davis. So the establishment survey, which publishes the payroll numbers that came out last Friday, as you guys know, there's been a huge amount of revisions. The prior 2 months were revised down 110,000 jobs. 110,000 jobs in 2 months? And the reason is, guys, get ready for this. The establishment survey, initial reach out from the government to the business. In other words, participation, initiation of the conversation, that rate in 2015, that initial reach out rate was over 70%. It's currently 32%. Only 32% of businesses that, by the way, pay taxes to the government are answering the question on the call. So the idea that any of these economic numbers should be used is just
hold on a second.
Outside of the realm for me.
This is pretty profound, Tony. Are you saying that either the beige book is more accurate, that anecdotes are more accurate than the hard data that doesn't have a high response rate, or just that you have to look entirely outside of the official data because it's all inaccurate and not giving a correct read?
I believe that's true. So what I use, Lisa, is I use those organizations, like the ISM is good data generally because it's an organization where the member firms are incented by being part of the organization to answer the question. But every other government-based data series, guys, go back. I got this great new assistant. His name is Google. Google soft landing scenario, soft landing Bernanke, soft landing Greenspan, soft landing Yellen. It's always a soft landing until you get to that hard landing. But again, just to be super clear, I want to buy the weakness versus trying to play it. I just don't see how you're going to get double-digit growth in earnings next year when you're already at full employment and absolute level of rates remains at the cycle high.
It looks soft until it's not. Tony, thank you, sir. I know you're a little bit under the weather, so feel better, buddy. Thanks for joining us this morning. Tony Dwyer there of Canaccord Genuity. Light and tight, TK, until we start to see some real weakness.
He's been really, really good about this. I mean, he's in the market like a lot of other people. You can't be 100% in cash unless you're me. But the answer is, he's been cautious into this and looks smart given the flatness that we've seen. Not so much the drawdown. I don't know if you guys, I was out yesterday, folks, had to get Afterthought back to school. She's taking physics.
Nice.
Taking physics.
Cool.
She went to school with my slide rule. I teared up. She took her slide rule.
You walked in the heat.
We walked in the heat. It was brutal out there. And the heat out there, I wanted to get to that, John. You follow this way more than I do. U.S. Open. I mean, Bramo's got box seats. But 502,385 people attended in the first week? That's ginormous.
Never mind the attendance, try playing in it. Danny Medvedev yesterday.
5 sets, you got to go.
Warning that someone's going to die potentially, Tom, in that heat. It's a real problem. They've got to work this out at the US Open. It's so hot for those players.
Full disclosure, I went, I think it was last year, the year before, and I was not impressed. It was way too packed. It was like, I felt like a sardine. It was just packed.
But this is next level heat, right? I mean, if you're playing
this is way worse.
top level athletics in 95-degree weather that feels like it's 108-degree weather when you take a look at the humidity, and you need an ice bath and you're feeling like you're going to pass out and die afterwards, when do you just say, okay, we're going to postpone it? But he acknowledged that's messy. People have a lot of money in
5 weeks ago, 6 weeks ago, in the Midwest heat, a San Diego Padres pitcher went down on his knees on the pitching mound, and they had to come out. I was surprised they kept him in the game, but they had to resuscitate him with Tang and, whatever they use.
Is that what they resuscitate?
Yeah, Tang Zero. It works.
Just a straight shot of vodka.
There's another story here as well, Tom. If you have Spectrum, you weren't able to watch that anyway.
Yeah, what is that?
It's some weird fight, and it's embarrassing right now for Spectrum and ESPN, because even the players are talking about their inability in their hotel rooms to watch the actual tennis themselves.
Small detail.
We'll catch up with Michael Nathanson in the next hour on that story. Looking forward to that. Seema Shah in the next hour as well at about 7 a.m. Eastern Time. Live from New York City this morning. Good morning.
Wonderful.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Today, Bloomberg's Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out today at 3:30 p.m. Eastern, only on Bloomberg.
It's probably wise from a risk management perspective and probably necessary based on the data that we've gotten that they keep that extra rate hike in there. The committee has to be ready to react and in a way that doesn't shock markets. I think markets should be putting some probability on that possibility, even if it's not maybe the main possibility here going forward.
Jim Bullard, the Fed whisperer, even though he's no longer at the Fed? The former St. Louis Fed president, Jim Bullard there. I thought he might be a little quieter since he left, Tom.
For those,
he's been
I
talking
agree.
week after week after week after week, and sometimes multiple times a week.
And on radio, you can't see it, but he's out at Purdue I think he's doing something with a football program.
With a
They play
questionable
Virginia-
tie shirt.
Yeah, they play Virginia
Get
Tech
up
this
there.
weekend.
Hey, I thought that's what the direction you were going in.
Well, there's that as well. It's a new look. It's a new boy look.
Slightly questionable, wasn't it? What was that, like a brown jacket with a light
It's
blue
like a
on
West
light
Lafayette.
blue?
When you go to Harry's Chocolate Fountain Shop, whatever it is out there, we're doing a remote from there.
I know.
It's scheduled for May next year.
Can I just take issue with this idea of a Fed whisperer? I think it's more like a Fed megaphone. I mean, honestly, how many times can you broadcast it? Anyway,
Okay, well, let's stop the show right
any
now.
insight there,
Okay.
Ramo?
Yeah, there is.
Some insight.
Let's do it here.
I would
What's
agree.
John Williams going to say today to Mike McKee? What's going to be his message?
Patience.
Does he reaffirm?
I'll tell you what the interesting conversation will be
him.
with John Williams and Mike McKee. John Williams has already set us up next year for something very, very intuitive, which is basically as inflation comes down, what they don't want is for real rates to go higher. They don't want policy to become more restrictive. They want to maintain restrictiveness. So he's talked about this on the record. I'd like Mike to probe just a little bit more, because I think the optics of that conversation are counterproductive. I think at this point of the effort to get inflation down, you don't want anybody talking about rate cuts. And John Williams has gone there. So now he's gone there. I think Mike McKee's going to have a little play around with that conversation.
I'd like to see if he reaffirms we're going to go back to a low R starred, which is his territory, and that'll be something. We'll see this afternoon, folks. Michael McKee in conversation with the gentleman from the New York Fed. Right now, the gentleman from Emerging Markets, Damian Sassower here, in the tumult, the mystery you have about China, about Japan as an EM, 147.48 on yen. But we're going to go a bit wonkish this morning, as Professor Krugman would say. Damian, we're going to talk about what matters. To me right now, the real rate in the United States matters. The inflation-adjusted rate, I don't have a quote this morning, 1.97. In your world, relative real rate differentials matter. So explain the real rate of Indonesia versus the real rate of pick another country.
So good that you picked Indonesia. They're one of the few countries now where market-based measures of real yields have actually turned positive, Brazil being another, Chile being another, et cetera. But what's interesting is if you look at real yield differentials between emerging market countries and the U.S., their local currencies tend to track that pretty well over time, right? So real yields matter. But, I mean, I think what we're seeing here now with Chile, with Poland more recently overnight.
That was a big cut from Poland yesterday, by the way.
Very unexpected. I mean, there's an election coming up, but no one saw this one coming. And, look, I mean, there's a cost of living crisis going on in most emerging markets right now. And if these central banks start to jump the gun and react to it, their currencies are going to suffer off the back of it. The zloty is down and down big today, and it's because of that big cut.
Doesn't this raise questions about what's happening just across the border with the ECB? So you've got the ECB potentially hiking next week, a week today, and you've got Poland cutting from 6.75 to 6%. What's happening there? Can EM really go in one direction and the ECB go in another?
Normally you don't see that. I mean, whether or not the ECB actually delivers on that hike remains to be seen, right? I think that's the big question right now. Look, I mean, everybody's been talking to me about China, right? We've got 7.33 on dollar yuan, and everyone's saying, what's the spillover to Europe more specifically, because we know there's a bigger corollary between Europe and China, as opposed to U.S. and China. I mean, China, guys, I mean, we're talking 50% of global commodity demand. We're talking the second largest, economy in the world. You just can't avoid it. And so what you're seeing there when, I think what the market was hoping for was some big bazooka stimulus to come in. But if they try to come in and stop the devaluation of the yuan, forget about it. That could destabilize the yuan itself. And its whole premise as being a reserve currency, a trade currency, will be thrown under disarray. And you're going to see capital outflows, such as what we're seeing, Lisa, from BlackRock and Fidelity more recently.
Which perhaps is the reason why we've seen more than 50 days of a stronger and the strongest peg for the yuan versus where it comes in, which is the longest streak going back 54. To at least 2018. So you are seeing an effort on that level. But is there a feeling, and maybe this explains some of the rate cuts in Poland and elsewhere, is there a feeling that a weaker currency could benefit certain economies at a time where growth is found in the U.S. but is scarce in other places, and exports is a key indicator and a key mechanism?
And you saw the trade data, right? But I'm of the belief that the gains from increased exports due to a weaker currency is not nearly enough if you're talking about devaluing the yuan, right, and destabilizing the yuan, and the capital outflows that can come off of the back of that. I mean, we saw Apple overnight, but forget about that. I mean, we're seeing capital outflows out of China. We've seen that for the better part of the last year plus. And I'm talking now we're seeing fund managers in junk debt, which is illiquid, which you really can't sell.
Wait, hold on a second. Are you saying that what happened with Apple and China will actually prompt more investors to withdraw cash from China?
Well, I think, yeah, well, let's think about China. China is using Southeast Asia as sort of an intermediary to deliver goods to Europe and the U.S., right? So all I'm seeing is more of a rerouting, so to speak, of components and what have you. But yeah, no, I absolutely do think trade's going to continue to go down off the back of this. And look, you were mentioning a little bit earlier, like, what does this really mean? Is it's not households in China who are not going to be using Apple phones. It's those employees at state-owned enterprises. Well, those state-owned enterprises, Sinochem, Sinopec, CNPC, employ millions of Chinese. And if they stop using it, rest assured, it's going to spill over to the households, and you're going to see a huge impact on trade.
You know, I got in Beijing, and I'm thinking of the Economist McDonald's Index, and I'm looking at a Big Mac in the Beijing for $1.90, or maybe it's $2. What do we know? It's 13.9 yuan, whatever that is. The answer is it's dirt cheap. Where is fair value on China? Do we have any metrics that say to us they're going back to 2005? It's undervalued now. It should go up. What's the value that we have there?
Fair value on a currency. I mean, if you look at anything like Big Mac, if you look at purchasing power parity, I mean, it's going to be very, very tough because the inputs that you're using for China just don't really add up. So all you can really do when you're trying to assess, the near-term direction of the yuan is look at, as we mentioned in the beginning of this conversation, real rate differentials. And if you look at the yuan and you look at the Japanese yen and most Asian currencies, they are now funding currencies. So it makes sense that when you see this risk-on mood, U.S. exceptionalism and otherwise, people are going to put that carry trade on. They're going to carry in the economies with high real yields, and they're going to sell those with low real yields, and that's what's impacting Asia currencies more specifically.
Have we got a decent read on their treasury holdings at the moment?
It came in last night. It barely budged, John. I mean, we don't audit that, so 3.1 trillion in FX reserves in dollar terms. I don't put much stock in it, unfortunately. I used to really love that number. It used to be at like 2.5. It was going up to 3. We're like,
why don't you love it anymore? You just don't believe that's the actual number?
Yeah, it doesn't move any much. I mean, I don't know. I just don't know enough about how it's calculated, unfortunately. I don't have transparency there.
This morning, Eric Schatzker will speak with a gentleman from Canada, Mr. Trudeau. Sassower on Looney.
Yeah. On Looney. That's a little bit out of my remit.
It's an emerging market.
But they did hold yesterday.
The Maple Leafs are terrible. The Canadians are terrible.
An emerging market.
It's an emerging market.
Okay.
Yeah.
I mean, look. I mean, if you want to talk G20, the original G7 was a G6. It was Canada that made it a G7. So let's look historically on how important Canada is to the developed market world. But taking a step back of that, this G20 meeting that's coming up, not having China there, is not really, a message directly at the U.S. I think you can't ignore what's going on with China and India, right? Especially on the heels of the BRICS conference, right? I mean, there's a little animosity there. Can't be ignored, and it's something that I'm keeping a pretty close eye on.
And Apple, once again, in some ways, at the epicenter of that as well.
I agree, yeah.
And South Korea with SK Hynix and these chips that are finding their way into Huawei phones. It's all coming together.
It's a fascinating moment. Damien, thank you. Damien Sasser.
I'm really big on his thought there on India and China as being
India, China, Canada.
No, but
as well.
Canada.
You're going to get some lovely emails this morning. Do you remember when Trudeau wanted to be the dean of the G7? Still entertains me. What's that about?
Well, we're going to have it's going to be a spirited conversation. Eric Schatzker with Mr. Trudeau at our new economy.
In about 20 minutes' time, yeah. We'll bring you some of that. If you're just tuning in, welcome to the program. Equities look like this on the S&P 500, slightly negative. We're down by 0.3%. Later this morning, some jobless claims in about 2 hours and 5 minutes from now, and a ton of Fed speak. Lisa went through the who's who. It's kind of like who isn't speaking on the FOMC a little bit later today.
Tom's speaking too.
TK's talking as well. Don't forget that. TK's the warm-up act for the Fed speak a little bit later. From New York City this morning, good morning to you all. This is Bloomberg.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Bramo already planning a next vacation.
It's just amazing.
Unreal, isn't it? Equities on the S&P 500.
Why don't we just book Rick Steves for an hour?
Negative here by about a quarter of 1%.
Bramo where to go.
Let's whip through the price action. On the NASDAQ, we're down by 0.6%. Down across the board here, the Russell, just a little bit softer, down by 0.1%. The NASDAQ, I guess blame Apple. We'll talk about that in a moment. The stock is down by 2.7%. In the bond market, 2-year, 10-year, 30-year, the 10-year yield, 426.78. It's down about a basis point today, but the 10-year over the previous 3 days of yields climbing ever higher. Tom, getting closer and closer to that cycle high, just shy of it by about 10 basis points or so.
There's interest there in the 10-year and the 30-year, but I'm going to go short here. The 2-year yield pushing 5% right now. The 3-month T-bill bursts out to 5.44%. We're going to get a 30-year bank rate mortgage here. I think that comes in the next couple hours. Right now up at a record high. And, there's just enough things pushing up where you go, what are the ramifications if we get to the next level of higher yields? I think there's a great unknown there.
Dollar dominance.
Yeah,
the euro.
no question about that.
The euro just holding on to 107 at the moment. The euro against the dollar, 107.10. The dollar, I didn't realize this until this week. The dollar index advancing for 8 consecutive weeks. This is week 8.
Yeah,
so this is 2 months of this now, Tom. Just this grind. You take this dollar strength story.
You take the two indices, the DXY, which is the major trading partners, and then the emerging market Bloomberg statistics, which are actually better, and there's just an inertial force here of stronger dollar. Explain to me how that reverses, and other than gross Fed action, which I don't think anybody thinks we're going to see.
Just south of 105 on the dollar index. Let's get to the data for you, and a whole bunch of stories as well. Under surveillance this morning, China planning to expand a ban on the use of iPhones in sensitive departments to government-backed agencies and state companies. This according to Bloomberg reporting. The move posing a threat to Apple's position in a market that accounts for about 1/5 of its revenue. This stock, Tom, is down 2.7%.
Pulled back negative 8% off where it was a number of weeks ago. There's a drawdown of 8%, and that's all fine and well, but I'll be fascinated how they respond. You mentioned earlier the diplomacy of Cook of Cupertino. It'll be just really interesting to see. I have no clue on this. I defer to Mark Gurman and some of the other people we talked to, but how do they respond to this? With silence? I don't know.
Next week is big. The unveiling of that iPhone.
And made bigger.
And a deadline for these talks between unions and Detroit. The United Auto Workers planning to make a counter-offer to Ford after rejecting the company's first proposal. Ford's offer, Lisa, included a 9% wage increase plus a $12,000 cost of living assistance. But that fell well short, of course, of the 40% wage increase the union was initially seeking.
Didn't the union call that offer insulting? Wasn't that sort of some of the language that they talked about? So while this is happening, today there's a meeting happening between General Motors and the union leadership to try to figure out what's going on with that. A lot of people have said Ford is really the leader here because they will be more amenable to certain union terms. Either way, if the union gets what they want, want and what they're asking for, that would be $80 billion of extra costs for each of the Detroit major three. And that, I think, is what people are looking at from an investing standpoint. Okay, well, what does this do to free cash flow and profitability? But on the flip side, you need the workers, and they want to get paid.
How do they compete with Tesla?
Yeah.
How do they compete with China? Even the German automakers, they're very, very concerned. You can tell about the competition coming from China and whether on a cost basis they can actually compete.
Yeah, and this has been an ongoing concern, especially with the electric vehicle push, right? How much of the union anger is really stemming from certain policies that prioritize electric vehicle production and that might come at the expense of some of the workers in the rank and file.
My basic take on this is there's a cross current going on right now. You mentioned EV, and yet I'm reading a lot from Bloomberg. Are EVs really selling? Where's the depth of the EV market that they've bet on? And then the other thing I look at here is the history where they pick one company, John. They don't strike against all of Detroit and Dearborn. They usually find the company they want to strike against. That's a tradition. Do they stay with that this time?
Well, to Bramo's point, it seems like talks with Ford on a relative basis, a little cozier than talks with the others?
There's a theory that I was reading about over the past couple of days that in union negotiations, they go after the lowest hanging fruit. And then they use that as a template to form the agreements with some of the other manufacturers. In this case, Ford seems to be that one, and that's why they're going after
So beat up on Ford first.
We'll try to extract as much as you can.
Quickly here, I got a run rate off the Bloomberg. Ward's total vehicle sales is not the boom time of years ago, 16, 17 million. I got a statistic of 15.4 million. So it's not a make it to the max auto industry.
I want to finish on this story. Gas prices are higher. They're particularly high for this time of the year. Crude is back to about 90. And then this drops. The Biden administration cancelling leases sold by the Trump administration in 2021 to drill for oil in the Arctic National Wildlife Refuge in Alaska and planning more conservation in the state's petroleum reserve. The moves after Biden controversially approved ConocoPhillips' 600 million barrel project in the reserve back in March. Now, Lisa, this is a curious one because on the surface, you can say it's Biden against the energy industry. And then you look at the data, and output in America is at 12.8 million barrels a day and just shy of a record. So I'm not sure what to say about this story this morning.
You frame it perfectly. I don't think you can overarchingly say this is the Biden administration against big oil. This might be a question on messaging and how you cater to both environmentalists while also fostering an industry that's crucial, right? I mean, energy independence is increasingly crucial, and that's quite clear. And even the Biden administration has kind of hemmed and hawed, but kind of, hinted that they can accede to that this is actually helpful. So I don't know that we can make something bigger about that. But I will say I was in Alaska recently and in one of my vacation plans. And so I can understand some of the vast wildlife and the tension with even people who live there who really enjoy the drilling and want that to foster the economy and to foster jobs at a time where there isn't much.
As a tourist, you don't want the eyesore of the drill when you look from your cruise ship.
First of all, I did not go on a cruise ship, okay?
Did not go on a cruise ship? We're selling cruise ships today.
We're not going to reprise this
Cancel
conversation.
that ad.
I will just say, but yes, it would be.
She's longitudinally, I want her life. I mean, she's in Norway, going over to Greenland to see polar bears, and then she's in Alaska.
It's well earned.
It's like she
continues to write the newsletter on vacation, though. Oh, she's impressive. That's impressive.
Work from V. WFV. Yeah. My basic point on this, and this is with the death of Bill Richardson of New Mexico, an energy secretary. John, we don't have an energy policy. So this is the Biden policy. But who's ever in office in 4 years, whoever that may be, they're going to have a whole new policy.
Yeah, that's
We're
the
making it up as we go.
I would agree with you. So the oil producers, the energy players, are in a bit of a tough spot, Tom. How do they plan?
Yeah, I'm taking a vacation. My goal is to get below 59th Street. We'll see if we can do that. Let's move forward here. An eventful week, to say the least. Jennifer McCown is chief global economist, Capital Economics. They write terse, really trenchant reports. Jennifer, I want you to validate the IMF call of a global tepidness out 5 years. Does Capital Economics, with the battles of China, all the other things out there, do you look for subdued global GDP forward?
Well, in the short term, absolutely. We think there are a lot of headwinds, but most obviously stemming from tighter monetary policy. A lot of that's yet to come through. I think we will see a recovery in advanced economies after this sort of period of weakness. And in particular, we're pretty optimistic about the effects of artificial intelligence on productivity growth. So looking out to those kind of 5-year horizons, I'd be a bit more optimistic, but not so about China. There are clearly major structural headwinds from China, stemming particularly from demographics, its state-led model, which mean that we think we've long expected growth to be slowing to kind of the 2% type level in the 2030s.
Well, that's right where I wanted to go. This is important. You got Capital Economics is modeling a 2% China GDP.
Yes, out by kind of in the next 10 years, yeah. So a significant slowdown, certainly from what we've become accustomed to over the past decade or so.
Do your experts believe that's workable in terms of the totalitarian mandate to employ the masses? How do you do that with a 2 or 3% Chinese GDP? The math doesn't compute, does it?
Well, it's largely about the state-led model, really, and the inefficiencies that has driven, which suggests that, I mean, China's no longer the developing economy that it was. It no longer has. It's expanded into global markets. It's clearly done what it can in terms of exports and infrastructure. What you need at this stage is a shift towards the consumer, to a more kind of a developed economy type standard model, and that's China's not moving that way at all. If anything, it's doubling down on its kind of state-led interventionist policies, which will be what lead growth to slow, alongside the demographics, which are just unavoidable.
What's the path for Germany to really climb out of this soft patch, potential recession that could last a bit, without China really picking up?
Yeah, I think to all intents and purposes, Germany is in a recession now, and that's likely to last for a couple more quarters, probably. I think the path for Germany to climb out ultimately will be policy easing by the ECB, but that's unlikely to come until well into next year, probably late next year. It doesn't stand to get that much support from China for sure, and car exports, although they've picked up quite a lot lately after this kind of dead cat bounce after the pandemic and the supply shortages around that kind of recovery is unlikely to be sustained. So what you'll need to look for is for the German consumer to start to spend again, and that's probably only going to come once we've got through this very, very difficult patch around policy tightening.
Jennifer, if this is a sort of recession that will continue, and we are seeing that weakness start to percolate out into even some of the economies that have gotten boosted by tourism in Europe and other industries, then are we going to see this actually cause inflation to come down? If it doesn't, what does that mean about both the ECB's role next week, but also going forward, what it will take to actually bring some price stability?
Yeah, I think it will bring inflation down. And I think already we've seen core inflation in the Eurozone coming off its peak. And there are various reasons to expect that to continue. Certainly on the goods side, it's very clear that the shortages that were driving up goods prices have eased off dramatically now. On services, we've still got further to go for sure. And in the Eurozone, you're not seeing the same signs of normalization in the labour market that you're seeing in the US so far. Labour market still looks very tight, and I think there's more upward pressure on wage growth to come. So it's going to be longer before the ECB can start to cut rates than it is for the US, we think, where core inflation is likely to fall much more sharply. But still, this recession will ease, resulting in easing in price pressures and in the labour market to some extent, which should allow the ECB to ultimately start easing policy. Next week's a very tough call. We're still going for a rate hike, although that's very much still in the balance. The minutes suggested that the ECB is now confident that it's seeing much more of that pass through.
Jen, quickly, we're out of time. Lucky for you. What's the animosity here between, if I have to pick, Germany and Portugal? What's the tension of this meeting next week between the centrist hawks and those more dovish?
Yeah, I think that there still is a tension, but with Germany in recession, that perhaps that tension isn't quite what it would otherwise be. Last night, the Dutch central bank governor was still saying that there's scope for another rate hike. So clearly there are still some hawks there that are looking for more, that are still concerned about wage growth, about inflation expectations. But yeah, it's clear that this tourism boost that we've seen in the south is going to fade, that those economies are going to start to struggle more. They're feeling the effects of interest rate hikes more quickly because of the structure of their mortgage markets. So yeah, we're going to continue to see that tension, which is, I think, one of the reasons why this call next week is a very close one.
Stagflation, TK, in Europe right now, the economy's stagnating.
Big time stag.
Got big inflation problem. Tough call for the ECB next week. Jennifer, thank you. Jennifer Mikion there of Capital Economics. They acknowledged that in the account of their last meeting at the ECB, and I imagine that's going to be acknowledged publicly in the news conference by some journalists, maybe 2, 3, 4, 5, asking that question hopefully next week, Tom.
Is Germany in recession, or is it something different? When you have factory orders year over year, smart people say negative 4.5, and it comes in negative 10.5. That's not a miss.
So people who follow that data know that German factory orders can be incredibly volatile.
Okay.
A little bit dated as well. But it's hardly an isolated data point, is it?
No,
the data out of Germany has been pretty terrible.
I mean, it's hard for me to gauge it, but it's more than a mess that Lagarde has to deal with.
Without a doubt, that decision, a week today from New York City. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
From New York City.
From London and Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
The Fed would be very unwise to raise rates again just because of a short-term spike in enthusiasm in the service sector. I think there's still a window for a soft landing, but I think they should be very aware of the fact that there is a squeeze play going on consumers. You've now got these higher oil prices, higher gasoline prices, you've got a resumption of student loans, people are having to deal with these higher mortgage rates. And they're gradually pushing up their credit card balances, but there's a limit to that. So you're going to see consumer spending slow down.
You might call that a toxic brew. David Kelly there, Chief Global Strategist at JP Morgan
There you
Asset
go.
Management. Brahma, where did I get that from?
I have no idea.
Equities right now on the S&P 500, down about 1/3 of 1%. There is one story out there that I think is dominating things for the stock market yesterday and today. It's the move low we've seen in Apple. Softer yesterday, again this morning. The stock is down by close to 3% now. I'll offer you the reporting, and then I'll get you some south side, some bullish analysis from the permable Dan Ives on Apple. I'm sure Dan won't mind being called that for this particular name. China plans to expand a ban on the US of iPhones in sensitive departments to government-backed agencies and state companies. This is a sign of growing challenges for Apple in its biggest foreign market, with about a fifth of revenue coming out of China. Dan Ives writing this morning, just to give you a little bit of perspective on things, some context. On the recent China news over the last few days, we believe in a worst-case scenario, any China government agency iPhone ban is way overblown. As to quantify, it's less than 500,000 iPhones of roughly 45 million we expect to be sold in China over the next 12 months. Now, they are the numbers, according to Dan Ives. I would raise this as a question, though, Tom. What about the signal that sends to the public in China as Apple unveils that new iPhone?
Well, yeah, I'd say that, but also what's the signal to Apple? I mean, you wonder when Apple really has to start making manufacturing decisions. They've done that tentatively. But my amateur take, this against off the world-class expertise of Mark Gurman, is it's been, sort of not clumsy, but it's just, we really like making phones in China, is sort of the feeling I get.
Well, and they have a good infrastructure to do so, but as John said, it's sort of at the heart of the G20 when you're looking at India and some of the manufacturing moving from China for Apple to India. I would just say on a larger scale issue, how much does this also indicate an acceleration of capital flows out of China? And this is what Damian Sassower was talking about. As investors say, if Apple, which employs millions of people, is going to be targeted by the government, who's next? Who's immune? Absolutely no one.
Who out of everyone handled the situation between US and China pretty well over the last few years. Just to put a price on Dan Ives and Wedbush, this is what they think. Outperform rating, 230 price target on the stock. Tom, they're calling the new unveiling of the new iPhone 15 a mini super cycle upgrade for Cupertino. That's the Dan Ives bullish view on this stock.
The smartest thing I've said when he was here last, I barely could handle it. He was dressed so much in yellow, my eyes were glazing
You're blinded
over,
by
the
the clothes.
Blinded by Ives. But the smartest thing he said was, there's doubt whether the cell phone companies, John, will finance your overpriced purchase of the toy. And Ives really pushed against that and said AT&T, T-Mobile, and the rest, Verizon, will pony up again and subsidize.
We'll see. I'm with you, though, Tom.
To me,
Consumer
that's
price tolerance. My phone's doing all right. I don't feel the need to upgrade this anytime soon.
I have
really
the new fancy
They
one.
gotta get on that.
And it's the battery.
Slow it down.
It's the battery.
Kill the battery, Bramo.
The battery on this was game-changing.
I know. You were the one that told me, and I did research about it.
They do. They slowed yours down, Tom.
No, mine hasn't slowed down, but there's two in the family that have broken in the last couple days.
Right on cue.
Right on cue. Yeah,
Perfect timing.
We'll have to see how that goes as well. Let's do commodities right now. We can do this with a trillion expert. Away from just oil focus, Koenigk is outstanding at ED and F man on the softs, on the agriculturals, and that. Kona, I'm really trying to cut back on my sugar consumption. I'm just thrilled with Tang Zero. It's really, really helped me out with less sugar involved, and yet sugar to the moon. Is there a global price for sugar? Should Americans be concerned about a surge in sugar in India?
Yeah, so we have the global sugar price that's actually reached 11-year highs. This happened yesterday. And it's because we're falling into deficit. This El Nino weather phenomenon that we've been seeing for the last 3-4 months really impacts the weather in Asia, particularly those cane-growing regions in India and Thailand, who are major sugar cane exporters. They're suffering from declining yields, and the world's just going to have to live with a lot less exports out of these two key regions. So I think that's just suddenly tightened the supply-demand balance for global sugar, which has caused prices to surge higher.
Well, I look at the prices again, but I want to go back to what it means for Americans, because I think, all of us around the table, Lisa, less sugar, John, less sugar, even I'm trying to cut back sugar. That's sort of a zeitgeist out there right now in America. Are we going to adjust here because of higher sugar prices like we would to higher cattle prices?
Difficult to see how quickly the follow-through will be at the retail level. I think, obviously, because it's the futures price, there's going to be a time lag by the time the sugar buyers actually start pricing that on at a supermarket level. So there will be some lag on that. Eventually, though, prices will probably have to rise higher. And then it's a question of, really, it's the income elasticity. How much do you actually consume sugar? Is it going to be high enough for you to actually reduce intake. I suspect that a lot of Americans probably don't consume as much sugar as maybe someone in Africa or Asia does, where sugar is a cheap calorie, which still compounds for quite a bit of your average diet. So I do think that in actual consumption, the trend has been falling definitely in developed countries because of obesity concerns, diet concerns. But in other parts of the world, I think sugar is still a very cheap source of calorie, where it's still very much part of the basket.
We weren't talking about sugar yesterday. We weren't talking about it the day before, even as it surged to 11-year highs. We were not talking about rice, even as it surged to 15-year highs. We were talking about oil, and we were wondering whether this was supply side or demand side, and whether this was something that was a broader indication of activity and demand, or whether this was something with Saudi Arabia sticking their thumb on the scales. Do you think there's something bigger going on throughout the commodity space with the price increases that we've seen in a vast number of specific sectors?
Yes, I think oil ultimately it's a linchpin. It's the driver of most commodities, and it's the biggest component in all the futures commodity indexes. So the fact that oil's reached $90 per barrel is significant, and it means that the whole commodity index pushes higher. For sugar, it does impact it because Brazil, which is the largest sugar producer in the world, has an optionality to produce ethanol or sugar, and ethanol is influenced by crude oil prices. So there is that linkage. But I think right now, today, the agricultural commodity sector is slightly diverged away from crude oil, only because we are looking at a weather market.
Yeah, but Kona, I just want to take this a step further, because let's say, just putting the agricultural side aside, there is a question about whether iron ore is sending the same signal that oil is, that something is maybe not as weak as people had previously expected, whether it's China or elsewhere, or if there is some other dynamic that could cause inflation to surge again in other areas. Do you think that that's a fair categorization?
I think one thing that is common to the whole commodity complex is the fact that China, which has been such a drag on the commodity sector for much of this year, is really talking up the amount of stimulation that the government's going to be putting in. So that in itself can provide some latent optimism that if China starts to stimulate its economy, there will be more demand for oil, agriculture, metals, you name it. So I think that could be definitely one potential. Otherwise, I think we're looking at pretty disparate little sectors, so ags, metals, and energy at this moment in time. And crude oil's rising only because of the OPEC cutback, because otherwise demand is not really shifted so much. I'd say the economic side for crude oil has been bearish to neutral, I'd say.
Kind of, we got to go. Thanks for the update. Kind of hack there of ED&F man. TK, I thought you were going to bring up the sugar lobby of the 1960s United States.
Yeah, I didn't have time
it is the problem now. We should talk about that one day. Yeah. The fact that we still deal with the consequences of that decades later today. The people still use fat as the problem.
Yeah, it's not just on sugar, it's on a lot of other products as well. I mean,
it's a cultural issue.
I didn't want to bring it up because Lisa's correct. We got to talk about oil at $90 Brent crude with Kona Haig, but you know, I'm sorry, it's an important thing, and as she dials in, it's about obesity and all that. And you know, all I can say is, you know, and bonus round Tang Zero is also gluten-free.
Can I just say, John's just trying to wind me up, because you know how I feel about this. I feel incredibly strongly about this, just like you.
Same way,
yeah, exactly. In terms of, if you want whole foods that don't have added sugar, that have whole fats, that's much better for you than fat-free. And, you know, tons of sugar.
Get to this point?
Well, yeah, sugar lobby, go back to it.
Poisoned in this country, and it's kind of bizarre.
Yeah, well,
and then this one guy becomes really wealthy investing in these companies that just go around poisoning
What book was that again?
people. Seema Shara, Principal Asset Management, up next.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance. Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television. People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on that folks are so excited about it. Climate tech is the hottest area to be in.
We wonder if the consumer is beginning to bend, not necessarily break.
I think the last thing consumers need at this point in time is a spike in oil prices and gas prices.
Does energy drive the economy, or does the economy drive energy?
Oil prices going up, even for a short time, just complicates this narrative for the Fed.
Figuring out when to stop the rate hike cycle is always a really, really tricky business for central banks.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Attempting to avoid a third day of losses here on the S&P 500. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Your equity market's negative by 0.3% on the S&P 500. Apple down hard this morning, off by 3% TK after a softer session just yesterday.
Evolving a lot of opinions on this, and I'd say a lot of unknown unknowns, as Dr. Alarian would say. We really don't know what the ramifications are. Certainly, you mentioned Mr. Ives with the bullish cast on Apple says it's not that big a deal. But I agree, there's a lot of jury out. When there's jury out, the bid walks away, and that's what we've got.
That's what we've got right now, negative 2.9%. The headline from our story this morning, at least, China's seeking to broaden the iPhone ban to state firms and agencies following the Wall Street Journal report just yesterday. Dan Ives framing it nicely, drop in the ocean, just in terms of what this could account for overall sales in China. But for me, Lisa, it's about the optics, the signaling more broadly beyond that story.
And I think it is a bigger story beyond just Apple. Apple was the brightest light in China. They contributed millions of jobs, and yes, they had a huge amount of manufacturing there. They were thought to have a symbiotic relationship with the nation. If the nation is going to go after them, if the government is going to target them and try to call out their phones, Is any investment safe, and what does this mean for capital flows? What does this mean for supply chains, and what does this mean to the cost of decoupling in a more meaningful way?
Well, and part of this is complications. In the opening there, Neela Richardson, always brilliant. She was great at Jackson Hole. And John, I love what she says about Apple, about China, about oil, this complicated September. I mean, it's just all of a sudden things are complicated, and all of a sudden there's Apple, oops.
We talked about that toxic brew. Oil, you mentioned oil, let's talk about that. Brent crude back to 90. So we've got crude at levels we haven't seen all year, gasoline prices climbing, the resumption of student loan repayments, retailers across America, from sporting retailers, Bramo,
really weak.
Walmart, Target, talking up the potential for weakness for the consumer as well. The problem we've all got with that, we've heard it a million times, and then you look at the ISM services number yesterday. If I just look at the ISM yesterday, no problem at all. Everything's okay.
Orders picking up, headline figure coming in above all expectations, even the price component ticking upward again for a second straight month. So not exactly giving that sense of gloom and doom. And then there was this from the Chicago Federal Reserve, a letter that came out yesterday saying that actually most of the effect of the rate hikes has already been transmitted, and that it looks very likely that we'll get back down to 2% by mid next year without a recession. So, you know, seeing that this softness is a positive, it's a positive toxic brew.
That's the kind of thing you'd expect to hear from Goolsby, right? We're done here.
Well, I mean, that's sort of the theme, is that we're
Mission
done here.
complete.
That basically most of the transmission has gone through the economy. There's a little bit more. It'll be the perfect amount to calibrate down to 2%, and boom.
So easy, isn't it? Make it sound so easy. And then you've got Tony Dwyer saying it looks like a soft landing until it looks like a hard one. That was Tony, by the way, in the last hour on this program.
Yeah, Trooper, he came on, he's really sick. 4-week moving average on initial jobless claims, 237, which is not where it was. I mean, it was a lot lower back. I got it down to low of 190, 191, rounded up. A year ago, claims were 190, and now they've ballooned out to 237. Baloney, it's not enough to change
John
John
Williams. If you took the chart out, remove the pandemic, like 230s, nothing.
Nothing's
Historically,
happened
just
here.
nothing.
How does John Williams with Mike McKee this afternoon address that? It's part of their dual mandate, and I guess we're employed.
The New York Fed president coming up a little bit later on this afternoon. I can confirm, Tom, you are employed. I am too. Bramo is as well. Hopefully it stays that way. TK. John Williams and a ton of Fed speakers.
Trying to get to Monday.
A little bit later. Let's get to the equity market right now on the S&P 500. Slightly negative. We're down 0.3%. Will we get day 3 for the S&P? 3 days of losses after a 2-day losing streak, amounting to a little more than 1%. In the bond market, yields lower by a single basis point. Lisa, the 10-year this morning, 426.59.
So we're going to be looking out for both things that you guys were talking about today. 8:30 a.m. We do get those initial jobless claims that Tom was mentioning that really have not gone up materially. When do we start to see the increase in unemployment, the increase in jobless claims that so many people have been expecting? Today, Fed speak galore. John was mentioning this. Let's give it to you. Philadelphia Fed's Patrick Harker, Chicago Fed President Austin Goolsby, Atlanta Fed President Raphael Bostic, Fed Governor Michelle Bowman, Dallas Fed President Lori Logan. St. Louis is having a forum to try to pick their new Fed president and figure out the parameters for that. And Michael McKee in the spotlight figure, other than Tom Keene talking, will be John Williams of the New York Fed. That will be today at 3:35 p.m.
This is the strength of America. This is such an eclectic brew. And to be fair to the Bank of England, they even go with foreign members on the staff. But all those names you're mentioning, Lisa, they have all radically different backgrounds. I think it's pretty cool.
And they all will come out and say, we don't want to commit to anything, and we have no guidance, but we're kind of going to try to signal hawkish maybe, but maybe also dovish. All right, and then we also get today President Biden leaving for the G20 meetings in New Delhi. Apple, sort of interesting. You were talking about this earlier. Are they front and center in these discussions as the U.S. tries to cozy up to India, especially as tensions continue to increase with Xi Jinping not attending this New Delhi summit?
Plenty of other little meetings to pay attention to, including the Saudis, and Alicia, you've mentioned that a couple of times in the last day or so. Looking forward to all of that. Joining us now is Seema Shah, Chief Global Strategist at Principal Asset Management. Seema, a line from Doug Cass moments ago. Why pay for Apple at 30 times earnings for slowing core growth? Now, Seema, it raises a question. Is this market expensive, or is it just a handful of names on the S&P 500 that are expensive?
That's a great question. Hi, John. Well, clearly we do know that those handful of companies are extraordinarily expensive. This is probably not the best time to be increasing your exposure to them. The market is looking pretty frothy. And then as you talk about the geopolitical tensions which continue to brew, maybe they do present some challenges ahead. And then if you look at the rest of the market, the rest of the market doesn't look that strong. I mean, you can see that some of the economic pressures, or at least concerns about potential economic pressures, are weighing on some company performances. Now, we could see that some of those valuations of those big tech names, as they start to be pressured, that's going to pull down the wider market. But ultimately, if we want to see a sustained, or if we will see a sustained drop in the market, it has to be driven by concerns about the economy, which, as you've said today, it's not so clear.
Seema, the heart of the matter, John Farrell mentioned this earlier, is stagflation is, I would suggest, a pretty wide outcome for a lot of our listeners and viewers. What if we get a true disinflationary trend based on tepid growth? All of a sudden, you got to model disinflation into the market. How do you accomplish that?
So, I mean, we are expecting the inflation numbers to continue to come down. We are also expecting the economy to slow down, which is what drives inflation lower. The idea is that, how much lower do they go? Do we go to the 2% level? What is the implication for the Fed policy beyond just the next 6 months of, are they going to hike again or not? It's really, that's the kind of the longer term question. Now, for us, I think it's actually a very difficult toss-up. The general thinking over the last 6, 7, 8 months has been actually that because of climate change, because of monetary policy, fiscal policy, you're going to have higher inflation out over the next 10 years. Actually, when you start to bring AI into the conversation, maybe that gets a little bit more dicey. So I think that conversation is still to be had if you're looking at over a 5-10 year horizon.
Just to bring these two conversations together, how much does this move against the iPhone, really, in China, accelerate some of the decoupling and some of the deglobalization, some of the supply chain sort of redundancies that have to be built in that are going to cause inflation to remain higher? Are you rethinking any of your theses based on increasing tensions there?
Well, actually, I think the geopolitical tension discussion and what the impact on global growth is going to be has been around for so long. This isn't, we have seen repeated moves by both parties against technology firms. So this, again, isn't a new conversation. I think for Apple specifically, it's a couple of months of maybe a couple of days even of struggles. And then the market goes back to responding and thinking about, well, what is the long-term productivity growth potential from Apple? And that's what drives the market. For the next 10 years, we do know, I think that's quite clear, that geopolitical tensions are only going to increase. The supply chains that we have been used to over the last 10 years, that is changing. We're thinking, all the new terms are coming up: friendshoring, nearshoring, ally shoring. These are all things that are going to continue to be perspectives which will put upward pressure on inflation. But I do think that has to be almost instantly offset by the idea that AI can put downward pressure on inflation as well.
So putting together what you're sort of seeing in terms of an investment thesis, does this mean that you're staying away from some of the big tech names just in the short run because of this lack of clarity, as John was asking about, in terms of valuation and what the forward look is, and going into bonds if you have conviction that inflation is going to come down?
So we have had an overweight to these large cap, mega cap tech companies. We are long-term believers in technology, and for us, that's a reason to stay overweight. Would we be looking to increase exposure at this point? No, because valuations are too extended, and we think there is a little bit of potential for a bit of a pullback. But the long-term perspective is important. Now, we also have a slight overweight on the duration side. So looking to increase our exposure to bonds because the expected drop in inflation driven by an expected weakening in the economy. So there are different levels within the asset allocation space. You said before, September, it's a tricky month. There is so many moving parts. There's so much data which is really contradicting each other that at this stage in time, I think cross-asset, we almost have to be neutral, and you're waiting for a clearer narrative to come through. But within the asset classes, I think you can take some longer-term perspectives, which show up through within the portfolio positioning.
So, what's your marginal allocation to the 7 or 8 big tech names? I think this is an arch issue.
We are overweight those big tech names.
Yeah, okay, you're overweight, so you're buying ever more of them?
Not at this stage. not at this stage, because the market is looking so frothy. And as you said, the geopolitical tensions, maybe at this point in time, for the next couple of months, who knows, is going to be a little bit more pertinent. But as a long-term investor, I'm not going to reduce that exposure for this point in time. I think that mega cap tech will continue to deliver if you're looking out over a multi-year period.
Hey, Seema, thanks for being with us. Let's catch up in London in a couple of weeks. Seema Shah of Principal Asset Management. The word geopolitics often frustrates me sometimes. It's a word we throw around to mean whatever we want it to mean, and some we don't quantify it because we can't. That's when it comes to markets. I think this is fascinating going into the G20, what's happening with Apple here. Dan Ives of Wedbush, of course, taking the other side of the story. He's out on Twitter. Just a little bit more context of his views for you. Despite the loud noise, Apple has seen massive share gains in China. Smartphone market, we estimate that Cupertino has gained roughly 300 basis points of market share in the key China market over the last 18 months. He thinks the iPhone 15 is going to help out on that effort. And he finishes with this, Tom. The bark is worse than the bite, in our view.
Well, this is what you're going to hear, but you've also got a lot of people looking at single-digit revenue growth overall, including what we're going to see rejuvenated here on September 12th. And the answer is there's a whole body of people saying, you know what, it's a great company, but, and I think I sort of heard that from Ms. Shah as well.
That stock is down by 2.7%. Some timely conversations going into the G20 for you, happening right now live in Singapore. Canadian Prime Minister Justin Trudeau speaking at a Bloomberg New Economy series at an exclusive interview with our Eric Schatzker. Let's take a listen.
Constructive, productive ways. One of the things that Canadians deeply understand is the global economy is not a zero-sum game. It is not just possible, it is only optimal when everyone gets to draw benefits, whether it's on trade deals, whether it's on business deals. If you're in it for the short term, you can do win-lose. But if you want to create stability in a long-lasting way, you have to make people understand that we are all deeply invested in each other's success. And that's a bit of a shift from some of the ways we've seen the global economy acting over the past decades. But climate and pandemic and the need for more resilient, diversified supply chains is driving that, and being there to show up and continually make that case is the most important thing that we can do.
I can't think of a country in the world that doesn't want to get more out of its relationships in the Indo-Pacific region. Which, you spoke of partners willing to engage. Which of the partners with whom you spoke, I presume in Jakarta, and will subsequently speak with in India, are most willing to engage? Which countries are stepping up?
I'm biased right now because I just came from Indonesia, but my conversations with President Widodo, with whom we'll be hopefully, but very much on track to sign a free trade deal within the next 12 months as a precursor to the free trade agreement that we're going to be signing with ASEAN, hopefully the year after. It's a lot for Mary to deliver on, but we're going to be able to do it because Canada has figured out, even this era of protectionism, how to get free trade deals done. And the key to that is, and it's certainly something that President Widodo understood and understands, trade, as you all know, creates growth. But it doesn't inherently make sure that that growth reaches everyone within communities and societies. And that's up to both policymakers and partners to make sure that people are feeling the benefits, because it goes to not just economic stability, but political and democratic and community security as well. So that pitch that we've continually made that trade can be about win-win, it can be about mutual benefits, flies in the face of the narratives that people are worried about around globalization over the past years, that demonstrates that, that we're able to engage. So I'm very bullish on Canada-Indonesia right now. But that might just be recency bias.
Mr. Prime Minister, how would you characterize Canada's relationship with China?
Obviously, we've had a challenging few years, as many people had. The arbitrary detention of 2 Canadians for political reasons put a real chill on the relationship. But China is one of the most important economies in the world and is not a country that anyone can simply ignore. We have to be eyes wide open as we engage. We have to look for where we're going to compete, where we're going to be very clear and contest based on our values, based on principles that Canadians expect us to adhere to. But we also need to look at where we actually can cooperate and work together. And one of the examples of that happened just last December, where Montreal hosted the Chinese COP15 on biodiversity. So Canada and China worked together to make sure that we came out of that COP15 on nature with incredibly ambitious targets of protecting 30% of the oceans and land on the planet by 2030. Now, that required us to work together and constructively, and on issues like climate, we are going to have to make sure we're working together.
So Canadian Prime Minister there, Justin Trudeau, speaking with Bloomberg in Singapore. You can continue watching that at Bloomberg.com and on YouTube. Bloomberg surveillance continues right now. TK, you'll recall that the Canadian Prime Minister was given a bit of a dressing down by the Chinese leader, President Xi. A diplomatic take there from the Canadian Prime Minister.
We're making the Pacific Rim circle right now. We've got to remember this within G7 and frankly in G20 is his closest approximation to a royal family that we have. He was 28 when his father died. This is a kid who in the nursery was handled by Richard Nixon. Pat Nixon brought him a Snoopy dog as a newborn. I mean, this is something, this guy was born to do this. And yet, Lisa, I've got Tristan Hopper in the National Post of Toronto, first reading, why Trudeau isn't resigning. He's getting clobbered in Canada by all sides, so why not go to the Pacific Rim?
Okay, there is that suggestion that maybe he's just trying to avoid the domestic politics.
Yeah.
On a broader level, there is a real awkwardness when the question of what's your relationship like with China, and I think that that's going to permeate all of the G20 conversation. What is your relationship with China? What is your relationship? Who's your alliance? Is it going to be the U.S. or is it going to be over on the Eastern Hemisphere?
If you're Europe, can you sit on the fence, Tom? That's the question. They've been sitting on the fence for a long time. How sustainable is that position now?
Yeah, I strongly agree with that Europe here with China is a major focus, and particularly with Huawei. It'll be interesting. You know, the fears that Americans seem to have on a bipartisan basis, I do agree that Europe is the tip point as well, but most of it's domestically China. I would suggest just domestically China. Right now, we're going to get a brief on this, and we can make it up as we go with Anne-Marie Horder, Bloomberg Canadian correspondent who joins us now. Anne-Marie, we just heard from the Prime Minister of Canada there. What is our relationship in Washington with Canada? I recall that President Trump had a tariff battle over lumber and such. Chrystia Freeland was going back and forth on that. What is the present relationship with Canada and the Biden administration?
Well, I think throughout history, even if there is arguments between Canada and the United States, that there is still friendly relationships, right? It's the United States' biggest land border. And this administration particularly does have a good relationship when it comes to Justin Trudeau and his team. A lot of that has to do with what they're doing in the Asia Pacific. You know, I've spoken a number of times with Canada's trade minister and the work that they are trying to put into what is going on in the Asia Pacific, trying to diversify supply chains. So they do see eye to eye in that. They also saw eye to eye in potentially what was going on and what they deemed as nationalist protocols when it comes to Mexico and some of their industrial policies. So I would say this administration has a good relationship with Canada, and they do seem to see eye to eye. And the United States almost sometimes feels like they're bringing Canada along in some of these discussions. But I would say it's a healthy relationship. And even if there's frictions in the past, for the most part, it usually is.
Let's segue here to the domestic front, Anne-Marie, as only you can do on balance of power. Help me with the president's relationship with what he believes is his core constituency, unions. Give us an update here as we stagger to Ford Motor and maybe next week a strike.
Well, yesterday he had the unions for the longshoremen, the individuals that work at the warehouse in the Pacific Rim and these ports celebrating this deal they were able to ink. It's going to be more challenging when you look at the auto workers. We are coming up very close to that September 14th deadline when that contract ends. What we do know is that the UAW was supposed to send back a counterproposal to Ford yesterday. It does seem that they are more ahead when it comes to negotiating with Ford than they are with GM and Stellantis. Maybe GM a little bit more friendlier than Stellantis. I think there's a lot more work to do. But when Sean Fain has been asked will you strike if you don't get a deal that you deem appropriate? He said yes. So they are preparing for that in terms of the unions. And it's going to be, as we've said a number of times, very difficult for this president. He does not want to see auto workers on strike. First off, that could be incredibly difficult for the economy, as well as the fact that there are lower supplies of vehicles at the moment. But at the same time, he wants to make sure he is standing behind these workers. He wants their vote. He has said time and time again, his almost most used phrase is, I'm going to be the most pro-union president in modern history. So that's going to be on display next week.
Anne-Marie, I apologize in advance for playing a bit of topic roulette, but just shifting from what we're speaking about with unions. So going forward, though, with respect to China, I am curious about how much the whole move with Apple ups the ante. There's also there are headlines coming out about potential additional steel tariffs from the U.S. and Europe on China. There's discussion about whether this reignites TikTok bans. How much is that discussion kind of getting reignited by some of the moves by China that we've seen over the past few weeks?
Well, I think this will be the elephant in the room at the G20. I mean, China, Xi Jinping, he is not going to represent China. He's sending someone else, a deputy. And so what you have here is the United States is really going to be trying to, with hard and soft power, explain to the other members of the G20 why they should be looking to the United States and not be looking to Beijing. One big topic, of course, is going to be how the U.S. administration really wants to bolster the World Bank instead of countries looking to Belt and Road for initiatives. And Xi Jinping will not be there. The issue is, of course, is that a lot of countries like the United States, have tremendous amount of commercial ties with China. And similar to Biden's difficult line he has to walk when it comes to the union, it's also a difficult line he has to walk with Beijing. There is still potential that Biden would sit down with Xi Jinping at the APEC summit in San Francisco before the year is up. That is happening in November. But how much can you do that and maintain a dialogue if you are poking the bear? The issue is, of course, when it comes to China, with things like the government saying they're potentially not going to let you use iPhones. It's similar to the way the United States said if you have a government phone, you can't have TikTok. Huawei comes out with a new phone. How did they get there? Representative Michael McCall is saying it looks like they potentially usurped sanctions. This means there's going to be a lot more pressure in this administration to maybe not take that narrow approach on national security when it comes to sanctions and export controls on China.
When I think about balancing the business interest with some of the political concerns with respect to the U.S.-China relationship, I think of Janet Yellen, who has often come out more on the pro-business side of things, trying to encourage the relationship, saying they cannot decouple from themselves, China and the U.S. Where is the mindset of the White House? Where is the balance of power in discussing business interests versus the political will to decouple more aggressively?
Well, Lisa, there's one thing this administration has wanted to make clear. It is not decoupling, it is de-risking, and still people maintain that they don't really understand the difference between the two. While you are correct, Secretary Janet Yellen of the Treasury really has been seen as a pro-trade individual when it comes to her past work as an economist. She did give this landmark speech, though, when she was talking about China this year, and she said, above all, national security is paramount to any kind of business we can do. So it's a similar message we heard from Gina Raimondo, who was the last of the cabinet officials to just visit China. And she said, we can have a bedrock of commercial ties to really ignite this relationship, revamp this relationship, but we will never walk away from our national security concerns. And that really seems to be the tone this administration wants to take.
MH, thank you. Anne-Marie, on the latest going into the G20 later this weekend. A bit of tension, Tom, over the last year or so between the State Department and Treasury on some of those issues.
You nailed it. And Anne-Marie, of course, always nails it. All this is U.S. officials, and I go back to the initial effort by Hank Paulson as Secretary of Treasury to go over there and actually jumpstart something in a honest China-U.S. dialogue. From what I can tell, they're just flying over to China to play to the American press. I mean, help me here.
I've talked about that a million times.
I just...
Follow actions.
Anne-Marie nailed it.
Not optics and rhetoric.
Optics, yes.
From New York City this morning, good morning. Equity futures near session lows. We're down here by 0.4% on the S&P 500. Yields down by almost a basis point on a 10-year. This is Bloomberg.
sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
We've talked a million times about Bramo Cam. We need Bramo Mike in the commercial break.
I go big little. I go like the sports.
Honestly.
You know, come on, Mina Kimes just signed her ginormous deal with ESPN. Congratulations to Mina Kimes for that. She can be like Mina Kimes in finance, where you do big little, and
Bramo
she's
Unplugged.
going mental there.
And Lisa Unplugged.
On a break.
That works for me. That works for me. I'll move on for you, Lisa. Equities on the S&P, negative here by 0.4% on the S&P 500. It's a pullback, a little softer. We're down by 0.8% now on the NASDAQ. We've got to keep one eye on Apple all morning. Their stock is down by 2.8%. So some real weakness in tech. Yesterday, some weakness in Apple again this morning. A potential that maybe that ban for the iPhone spreads at the Chinese state level, Tom, to other agencies, to state firms. This is going to become a bigger and bigger story going into next week when we get the new unveiling of the new iPhone, Tom, the iPhone 15.
You wonder if they'll break protocol and come out before earnings and make some form of statement. Moments ago, the first publishing the 10-year real yield this morning lunched 1.97%, and I would suggest that folds into big tech, and then they have to deal now with a substantial real yield.
Let's turn to fixed income. 2-year, 10-year, 30-year. 10-year looks like this. Your yield, 426.98. Let's call that 427.18 now, just turning back up to 427. Yields higher for 3 consecutive days. Yields up for 3 straight sessions, and not a million miles away of the cycle high from a few weeks ago of 436 on a 10-year. A 2-year yesterday, for what it's worth, closing above 5%. The 2-year this morning down a couple of basis points to 499.30. And I talked about that tension in the market, particularly at the front end in yesterday's session. The beige book said a little bit of weakness, maybe even a soft landing, a slowdown perhaps, raising those kind of questions, those themes. Then the ISM was just like, yeah, what slowdown? And then that's when you saw that yield move, Lisa, at the front end.
What's interesting to me is what data the market responded to. And does this mean that the market has more confidence in the ISM figures? Or does it mean that there is a bias already baked into markets looking for a stronger than expected economy, leaving rates higher for longer? A consensus shifting more to the Jim Bianco point of view rather than the Bob Michaels point of view.
We're drowning in ambiguities right now. I think I love what Naylor Richardson said as we opened this hour. I guess you had her on yesterday. And the basic idea here.
Thanks for following the show yesterday.
Yeah, I did. I was on top.
Appreciate that. That's
I'm
good.
watching on my phone outside. I'm outside school and they're talking about Pharaoh. I mean, they don't talk about me or you, Bramo. They're talking about Pharaoh. They're like, John Pharaoh got us through the summer. And I'm like, what? I didn't get you through the summer? Lisa didn't get you through the summer? Wait, Lisa wasn't here.
You're talking about yourself. You weren't here.
Well, I had some illness there, you know.
That's true.
That's
true. You're still recovering.
You know,
we'll give you a break.
Yeah.
Let's turn to foreign exchange just briefly.
Foreign exchange, please.
The euro clinging at 107.
Clinging.
107.07 and breaking down. We're down by 0.2% on that currency pair. The latest data, the GDP, I think put it this way, there is barely any growth, if any, in Europe right now at a time where inflation is still elevated. The ECB is trying to do what it's got to do. And Tom, this for me, I talked to Guy Johnson about this a number of weeks ago. This is really important stuff here in the United States. So here we have an economy, a case study. They've already got the damage done to growth, but they haven't got inflation anywhere near back to target.
But
what's happening in
my
Europe?
textbooks, which I guess aren't valid anymore, is if you do get growth slow down, somehow you get disinflation. And I would really love to hear what John Williams says about that today with Michael McKee.
What's the lag? I guess we'll find out from President Lagarde, and we'll get her view a week today. Crude, by the way, for what it's worth, still Brent, $90 a barrel. WTI just about unchanged today at 87. Let me bring you the data wrap. Under surveillance this morning, China's trade slump easing, but still in contraction. Exports falling nearly 9%, with imports sliding just over 7% last month. However, in that data, demand for commodities surging. Lisa, for the likes of coal, crude, copper, and iron ore. And that supports, arguably, what we're seeing in the market for iron ore and crude right now.
So China may be slowly decoupling from the U.S., but still having more strength than some people are giving credit to. And I think Leland Miller was pointing to that. It might be more domestically focused, but it is bleeding out into certain commodity markets that we keep talking about that might fly in the face of China's falling off a cliff kind of narrative.
Nailed it. And I would say for all of our listeners and viewers, get your radar up, because people are conflating their domestic balance sheet challenges, some of the COVID demographics and that, with their foreign economic dynamics. Baloney. It's not the case. You know, somebody said earlier 2-3%. Do they come in at 4 or 5%? I don't know, but there's a school of thought on that.
That's the data out of China. The data out of Germany, off the back of that weak demand in China, looks like this. Another disappointing note for Germany, with industrial output falling again for the month of July. Meanwhile, Eurozone GDP barely growing, with a read of 0.1%. for the second quarter. Looking ahead to the data stateside, jobless claims a little bit later this morning, just under an hour away. A slew of Fed speakers going to respond to some of this. Lisa went through it earlier. It's worth going through it again. Harker, Goolsbee, Bostic, Bowman, Logan, all ahead of the quiet period. Plus this one. This is the big one. Mike McKee sitting down with the New York Fed President John Williams, 3:35 Eastern time. So a little bit later on, Tom, this afternoon. That one in focus, I think, for all of us a little bit later.
Who is this guy? For those of you not keeping score between Goolsbee and Williams, this is the monetary theorist with Mr. Laubach. He came up with R-Star, which is a double plug-in idea of what's the most optimal place to be for growth given inflation. And the answer, as John Williams suggests, we will migrate back to a pre-COVID lower R-Star. Many others disagree.
Is there some tension with Chairman Powell on that? We talk about the core of the Fed, that three, the vice chair, the chair, New York Fed president. Chairman Powell doesn't want to engage in that conversation at all, based on what he said in Jackson Hole.
He's like me. Chairman Jerome Powell can't do the math. Christine Lagarde can't do the math. Tom Keene can't do the math.
Hey, John Farrow can't do the math either.
Powell's going to listen to the people he has that do the math to find out if 2.0% is a new 2.x%, as Clarida, who can do the math, would suggest.
John Williams, a little bit later on, Tom, this afternoon with Mike McKee.
Yeah, looking forward to that. It'll be interesting to see. Let's get a brief now on the global economy and also on the American economy with T. Rowe Price. Blarina Urucci joins us right now. Blarina, you had a single sentence that's absolutely really harkens to our conversation with David Folkerts-Landau in London here in about 10 days. And Blarina, it's real simple. You see growth resilience with fiscal support to the rescue. Where's the fiscal support going to come from?
It's so interesting because when we've looked at the traditional measures of fiscal impulse, the declining deficit, the declining government spending growth, everything has pointed to fiscal not really being a tailwind to the economy. But actually, you have to dig deep and look at how the Inflation Reduction Act and CHIPS is funneling into the manufacturing sector and driving manufacturing construction at a time when residential investment is collapsing. And you need to look at how small business balance sheets are being boosted by the employment retention credit. And all that, I think, are providing another lifeline to the economy at a time when interest rates are increasing significantly.
Well, let's cut to the chase. Sebastian Page of T. Rowe Price would be rude. He'd be in the meeting and go, Blarina, don't give me the concept. What's real GDP going to be? We're not going to sustain 6% real GDP. But what level are we going to sustain if we get a buoyant fiscal support?
You know, we think about potential GDP in the US that's somewhere between 1.5% and 2%. And the truth is the second half of the year is shaping up to be again above potential. And we have an unemployment rate that is at historical lows. And the recent increase in the payroll data for August was driven by increasing participation rates, not because we're laying off workers in large scale. I mean, that points to a resilient economy.
A Chicago Fed paper came out and said that, yes, the economy was resilient, but it is slowing, and it has basically felt most of the impact from the 5.25% increase in rates, or 5.5. So that is sort of the level that we're at. Do you agree with this? They also are seeing inflation coming down to 2% by mid-next year and us avoiding a recession.
I think this is a very difficult question for all of us. The truth is we've all been looking for a recession because of the speed at which interest rates have been increasing. But what's different in this cycle is the health of the balance sheet of the corporate sector and the consumer sector, is the fact that a lot of the debt in the US was locked in at the old lower interest rates, which means we should be looking for the lags of monetary policy transmission into the indebted sectors of the economy to be longer. I get it that policy transmission is faster through this forward guidance and financial conditions channel, but the fact is when debt is fixed, then that makes the economy not as sensitive